Keeping busy. How about yourself?
It's been a while, hasn't it? We haven't done a space. Feels like
I
forever.
know it's a little weird.
Yeah, it's kind of wild.
I'm not gonna complain. By the way, I'm happy. Gives us time to prep. Tomorrow's space is gonna be a pretty crazy one. So,
Oh
Oh yeah.
yeah.
all right. So Eric, I'm just gonna send you because I see Eric in the audience. Eric and any other speaker, you're just gonna get a DM from me now with the invite um, to the space. So I just sent out many invites, and you could access it from your DMs. So it should work from there. All right, I think we're good. I think all the invites are out. Give it some time for the audience to join, for the speakers to join, but the invites are all out. I see Isabella just joined. How are you, Isabella?
Hiya, can you hear me?
We can. How are you?
I'm good, thanks.
All right, so I see some of the speakers are still in the audience. If it doesn't work from you for the link, you could leave the space for the speakers and then click on the invite. I DM'd it to you. If you're having any issues, just DM my account and the team will sort it out for you. Let me see if there's anyone else I'm missing. No, I've sent out all the invites. It's gonna be exciting. I think this is the first time we stream the Fed meeting. We've almost did it last time, but we skipped it due to unforeseen circumstances. That'll be our first stream, and this is like for me, this is like Christmas for Wahid. Wahid, who's the account is Faith Tribe. When I say Wahid is Faith Tribe, this is this is his obsession. This is his Netflix. This is like I invite Wahid to any space, whether it's crypto or politics. Somehow he starts talking about interest rates and the Fed and the economy. So for him to actually have a space about this stuff makes his day. It's gonna be his
All right,
highlight.
now I get to get the record straight. Okay, that's not true. I actually hate this day. I am obsessed about it, but it's not my fault. Don't shoot the messenger. These idiots for the last 40 years have rendered the entire world under their thumbnail, basically. So basically, what they do with monetary policy, what they do with financial conditions, dictates all of our lives. It sucks. I hate it. It's not how an economy should work, but it's the reality. And how we allowed this to happen as a global populace is just beyond me. But unfortunately, we are where we are.
So you're complaining about the centralization of power, all the work they've done, and whoever was speaking next, I'll let you jump in right after.
It's insane. They call the U.S. president the most powerful person in the world. It's not true whatsoever. Every single politician, well, not every single, but in democracies, is held accountable. These are unelected people. They've gotten monetary policy so badly wrong in the past. They're never held to account. They never resign. They have absolutely no shame, and we keep giving them this unlimited power. And it's just unreal.
Well, and
Eric,
what's even worse
Jim.
is their entire methodology is a demand side methodology. And you can argue between what's demand side and supply side economics, and I'm a supply sider, but nonetheless, however you want to argue over that particular aspect of it, we could certainly do it. This is all demand side approaches to the economic puzzle, and most of that benefits certain players who have an inside knowledge. So what makes it even worse is not only are they jimmy rigging where we're at in our economy and literally putting their fingers into economies, not just in the United States, but elsewhere, they are doing so at the behest often and the benefit of certain very large players. It's insane.
100%. So well said. So the reason why it's demand driven is because they lost control of supply, obviously, because the codes that dictate people's incentives to actually do supply, productivity, and PP&E and all those different things that actually create value long term, all those signals have been obliterated with the financialization of the world. Company and interest rates being held so low for so long. people have lost the incentive. And so everyone is a stock junkie. Everyone wants to trade. Everyone wants a quick buck. Everyone wants to be a blogger. Everyone wants to be a social media star, right? Like Mario. Okay. And no one actually wants to build shit. No one actually wants to drive productivity. So you're 100% right. So all we're left with is demand-driven Fed policy. And worse than that, they're always behind the curve. I mean, frankly, if they just allowed the bond market to dictate, they always come around to the bond market signals. I just don't understand what value they add. But again,
Can
we are
someone
where
can
we are.
someone actually can someone disagree with Wahid? Not agree at Wahid or Jim? Like I want someone to start giving some credit to the Fed. Everyone was talking about doomsday scenario, and they did it in 08. They did it again during COVID. They did it again last year, and
Because
here
they
we are still
created
humming
it,
along.
Mario. They
You can't.
created.
They didn't create COVID. They didn't
They
create. You can.
they didn't create
08 was a
COVID,
lot
but
more complex. 08 was a lot more complex than the Fed decision. It was just completely misaligned incentives. I think it was more complex than just the Fed. I'm just trying to play devil's advocate here because it seems nobody is. But
Yeah,
it's very hard to play
one,
devil's advocate. Go ahead,
but
Jim.
one thing to keep in mind, Mario, is that COVID, they did do it. So the money that was spent, particularly here in the United States, but really in other places too, not always financed by the American Federal Reserve, but also by the ECB and other similar organizations, the debt that was created when they shut down economies and took activity away out of the
But the
economic
Fed, hold
system.
on, the Fed didn't shut down. The Fed didn't shut down
No, hold on.
economies.
No, I understand that. No, they didn't. But what they did is they gave government incentives to go ahead and shut down economies so that they could do stuff with money. And we're talking about multi-trillions of dollars in every major nation or group of nation states like the ECB goes over. They gave them trillions and trillions of dollars because their policies financed this through money printing. And now that they've created the problem, they got to come back and fix it. And this is why I make the demand side argument,
Jim,
because
what would have happened otherwise? Like, it's easy to say all this. Now, the economy shut down. It is what it is. But if the Fed didn't step in, or it didn't step in 08 and do what they did, we could be in a significantly worse off position. Like, it's easy to say they could have done this. Hindsight is 2020.
Actually, I think it is easy to say, and Wahid probably is going to want to put his twist on this, so I don't want to take up too much of it. But let me say this. This is why I make the demand side argument. Because most economic problems take place when the supply side is put at risk through regulation, through taxes, and through other government policies, through other constructs. And that the supply side, the reason I feel like that, no, I know what would happen is, see, you took the supply side out by shutting down economies. And particularly in certain key sectors like the service sector, represented mostly by restaurants, and some other places that were more directly affected by policies designed to protect from COVID. But you kill the demand. This was like the COVID situation was an extreme way to kill the supply side. We do this in small, seemingly small and incremental ways all the time, but COVID was just extreme. So you cannot do the policies that governments did during COVID without a Federal Reserve system, because if you have to rely upon a relatively objective standard of money, then you cannot do stupid crap in these governments. That's the point I'm making.
I want to go to Wizard and Isabella. Before doing that, just I've got a bunch of questions prepared, and I do want to tell the audience, before introducing the speakers as well, the panelists, that the stream will start at 2 p.m. EST. And correct me if I'm wrong, anyone, but that's in 1 hour and 15 minutes. Not the stream, that's the announcement, the decision. And then 30 minutes after that, at 2:30 p.m. EST, which is in 1 hour and 45 minutes, we'll be live streaming Powell speaking and the Q&As. So that's what you guys could, the audience could expect. But otherwise, what we're going to do now is discuss what we all expect the decision to be and how each scenario will impact the economy. And we're not only talking about the macro state of things, but also going to get into crypto and other asset classes as well. And for the audience, if you've got any questions or any comments, we always go through them. If that's your first time here, bottom right corner in that purple circle, we always go through that. We've got other panelists joining, so we'll give them some time. Otherwise, Wizard, good to see you, man.
Hey, what's up, man? Yeah, good to be here. Yeah, just I'm happy to give a little bit different, a different type of view here. I saw some comments about supply side and demand side. So I think the only thing the Fed cares about right now, obviously because they messed up with not being able to gauge inflation being transitory, was the fact that goods inflation is coming down, right? Like that's regardless of whether you like the measurement or not, CPI is what they kind of use for it. So price stability, part of the dual mandate. You could say there's a third hidden mandate, but that's kind of offline right now. But the dual mandate, has price stability, so that's inflation, and then there's employment, right? So price stability is kind of doing okay. We're seeing goods inflation come down. We're seeing supply side, a lot of the disruptions from COVID, from Ukraine, so on, kind of easing out. The core inflation, obviously, we've seen some issues with that. But core inflation, the biggest component is rental, which has obviously got usually on average a 9-month lag. We saw that 9-month lag as inflation picked up, and we're seeing the 9-month lag. We are seeing it at the moment as inflation is coming down. The bigger concern for the Fed, if you go listen to every one of the Fed speeches, especially Powell's speeches, and just in general, even if you look at the famous Fed whisperer Nick in Wall Street Journal, who always leaks. Well, the Fed always, FOMC always uses Nick to kind of leak information to give guidance ahead of speeches, ahead of FOMC. The biggest concern for them is wage inflation, and that's part of the Phillips curve. So the Phillips curve is kind of the main thing that the Fed uses to kind of do their study on how much they should keep hiking, how much they should cut, etc. Now, regardless of whether you agree with the Phillips curve or not, is a whole different thing. But essentially, Phillips curve kind of tells you, as unemployment goes down, you see demand increasing, and which will result in price increasing as well. So that's goods prices, wage inflation, and so on. So the wage spiral is the main thing that the Fed is concerned about right now, which is why, for example, yesterday when the employment cost index numbers came out, it was 1% relative to 1.1% expected. The market rallied, and that's kind of the only thing that the market's kind of, especially the bond market. Like if you look at front end rates, short-term rates like the 3-month, 6-month, or SOFR rates, LIBOR, like the new LIBOR, everything is kind of pointing to all wage inflation metrics. So why does that matter to the Fed? Because if you look at the wage spiral, so think about it like this: if you have as inflation has been going up, there has been a scarcity of employment. So there's not as many people post-COVID. Like there's more jobs out there than people, kind of thing. So there's a scarcity of labor. And what's happened is people just ask for raises as inflation has gone up. And if you see earnings have been really good for most companies. So the companies and corporations have just been passing out over the cost to consumers, and then the consumers are asking for raises, and so you saw wage inflation kind of increase. So you had the first wage inflation decrease happen in January of like this past month, which is when basically you saw this whole bear market rally start. So wage inflation came in at 4.6% approximately year over year, which is like one of the lowest in like 2 years. That's literally what started this entire bear market rally that sent crypto up, sent stock markets up, sent rates lower, sent dollar lower. So that's basically what everything is.
What started? So was it just? I want you to keep going, please. I want to just break down what you've said so far. Before getting to the wage inflation points, because there's a lot of people in the audience that understand all this, others that don't. So I want to explain it to those that don't. What did you say started the bear market? Wage inflation?
No, the bear market rally in January was started because
the rallies. Okay.
Yeah, it's because the way you measure the wage inflation is essentially average hourly earnings. So every Friday, the first Friday of every month. So this Friday as well, 8:30 a.m. EST, you get the non-farm payroll number from the BLS. So you go to bls.gov. That is hands down the most important macro number at the moment. So in that data point, there's the headline employment. So what 200,000 jobs were created, et cetera, et cetera. But there's another metric called average hourly earnings. That is the most important number. That's what started the entire bear market rally over the last month. Anyways, go ahead.
Okay,
Yeah.
so
Hey,
wage
so
inflation.
Mario.
Go ahead, Wahid. So I want to explain. I want to explain. Wahid, can you explain wage inflation briefly to the audience? I think Wizard explained it pretty well. From what I understand, is essentially, or for the audience to understand, it's a better way to put it. Unemployment drops, wages increase. I'm just going to mute. I think it's you, Wahid, has a bit of feedback sound. Unemployment drops, wages increase, companies have a higher cost, and they'll pass on those costs to consumers through higher prices. That's the spiral of wage inflation. Wizard, did I get it right before going to Wahid?
Absolutely,
yeah,
you did.
Perfect. All right, Wahid, go ahead, and then we'll go to Eric and Fried. Go ahead.
No. Look, this was, Wizard gave a great summary. I just want to contest one thing, which is let's talk about what the story is today. The story right now is this huge tug of war between the Fed and what the Fed would like markets to price and what the markets are actually pricing. Actually, the markets are pricing a colossal Fed mistake. You look at a hugely inverted yield curve, which means that future yields are much, much lower. We are at almost record inversion, which obviously usually is a very, very strong predictor of recession. But what it does is actually the markets are pricing in rate cuts by the end of the year. So it's saying that there's a Fed policy mistake. And here's what they're looking at. They're saying goods inflation is going down. Wizard articulated that perfectly. That's CPI and core CPI. 40% of inflation is owner's equivalent rent. That has a hugely lagging indicator, 9 months. Wizard talked about that. But the market looks at where rents are going, where home prices are going, where building permits are going, where new supply is coming, and they see that actually real estate is rolling over hard. So goods inflation coming down and actual real-time real estate prices and rents going down. If you look at actually 3-month annualized change in inflation, we're now at actually one handle. So even below the 2%. All you do is you look at 3 months rolling and then you look at the change. And so the actual inflation is dropping fast. And that's what the market is saying.
And why is that a bad thing, Wade? If inflation is dropping fast, which interest rates
I'll tell you why it's a bad thing. Thank you. Very good question. So here's the issue. That's actually a beautiful thing, right? If the Fed capitulates. But if the Fed, see, they're always behind the curve. The market was screaming at the Fed, saying, guys, you have an inflation problem. You have an inflation problem. And then he went on at Jackson Hole, not this year, the one before, right before his Fed renomination, and he said, there's a huge risk that if we don't allow inflation to consistently be above 2.5%, inflation is transitory. Boom, it wasn't. The market was telling him that for months. Now the market is telling him, hold your horses. You're going too fast, too quickly, and doing too much because all the inflation.
So you think they're pivoting? You think they're pivoting too quickly? Is that what you're saying?
No, the market is telling him that he needs to slow down. He's not pivoting fast enough. And he's looking at financial conditions and seeing that they're even easier than they were in the last 6 months because the market is ripped, the bond market has also gone up, so that yields are going down, etc. So the market, Mario, is telling basically what is the story. Let me make it simple. There's a tug of war going on between the Fed wanting to keep financial conditions tighter, wanting to raise rates, stay higher for longer, and the market is saying no. You got to start cutting at the end of the year. That's what the bond market is pricing.
So what you're worried about, Wahid, is that the markets are telling the Fed to ease up quicker, and then when the Fed doesn't do that, the markets will not react positively.
Exactly. So today, if the Fed jawbones the markets to say no, we're not going to let loose. We're going to keep this higher for longer. Maybe we do 125 bips and yet another one, and then maybe slow down and watch. But we're going to keep this thing tighter. If they go too far, and the market is shocked into going hawkish, then yes, we will get a correction. That's the tug of war. That's the story.
And by the way, before going to Jim, Jim, just want to add one thing. Wahid, you remember when you used to talk about this before, and you kept telling us, guys, the Fed will pivot and we'll see a massive rebound. Are we seeing what you were predicting earlier? Then I want to go to Jim and Eric.
So what I had predicted all last summer was the Fed would pivot, right? I was wrong. The Fed didn't pivot, but the market pivoted. So I got that right. So the market is saying inflation is slowing down and basically started pricing in and easing at the end of this year. I know this sounds shocking given that we're still raising rates. Okay, but I remind people that when inflation was screaming higher, the Fed was still doing QE. I mean, that's how bad these people are. But I'm not going to berate this over and over.
You need to stop berating them. I want to go to Jim and then Eric. But by the way, just for people in the audience, number one, I see a lot of crypto peeps here. We will be talking about the impact of this on crypto as well as other asset classes. That's number one. I think a lot of these asset classes correlate. So when we talk about equities, obviously equities, going up, is cryptos is going to probably go up as well. That's number one. Number two, I want you to ask questions or give me a bit of feedback. Bottom right corner in that purple circle. Tell me if you don't understand a specific thing or if you have a specific question. The team's going through those questions. Otherwise, we'll go to Jim and then Eric. Go ahead, Jim.
Yeah, just real quick, and I'm gonna make another big point and then let others talk more because I got a lot to say about this, and I'm like Wahid, like this is Christmas in the sense of my interest in it and my concern about it. But Wahid, one other thing that you didn't mention there, and it affects the bond markets and other factors as well too, there is remaining monetary pressure. Like whatever they do with rates right now, monetary pressure is not resolved. And so this is what we're seeing. And even though we're seeing goods inflation go down, that's off of massive peaks. Like the core inflation, the real core, not what the government agencies say is core inflation, but the real core inflation is not starting to settle away. It's settling off of massive highs. But the bond pressures, I mean, because they still have a lot of QE to roll out. And that's going to cause monetary pressure, not to mention the inset monetary pressure because of where M2 stands right now, which is also a core problem with what we're seeing happen in general inflation. Those things don't get resolved, whatever they do on the interest rates, for a long time, and that continues
Right.
the problem.
So, Jim, I believe they're going to have to give up very soon for another very big elephant in the room we haven't talked about, but I usually talk a lot about this on Spaces, which is that no one can explain to me how another 50 to 100 basis points or increase, or even sustaining interest rates today, how we're going to handle, given we have 330 trillion of sovereign debt, another 200 trillion of corporate and consumer debt, and another 250 trillion.
So what do you? So how? So Wahid, just kind of simplify that first. What does that mean for
basically
for macro for crypto?
So let me make it simple, okay? If 2008 was bad, we have seven times the aggregate leverage today. 7 times. In America, we have 3 times the aggregate leverage today. So like this is like nitroglyceride, okay? That is about to be lit up. So the reality, Jim, is you're 100% right. You're saying that whatever they tinker with, we still have structural inflation because core is underrepresented, has been underrepresented for 2 decades. You're talking about structural inflation. That's not going to help. The reality is we're probably going to have to live with structural inflation. We're probably going to have to, there's going to be a scenario where they're going to change the neutral rate from 2%, 2.5% to 4%. And they're going to start accepting a higher level of inflation because no one can explain to me, and please, anyone from the audience, how on earth we're going to handle our debt bomb. Okay, so the only way you do that with the supply side being so distressed and having no productivity, and Apple basically consuming the debt markets and mom and pop shops not able to get loans, etc. So the whole system being, rigged upside down. The only way, the only tool they have is easing the financial conditions and letting inflation be structural. So that's how I see the world.
I want to go to Eric, and then I see Chadwick, Isabella. Good to have you for the first time on the panel, and I see a regular Simon. Good to have you as well. So Eric, I'd love you to play devil's advocate. So Wahid is ringing the alarm. Wahid Faith Tribe is ringing the alarm, and it's got a lot of concerns with the Fed and where the economy is heading and the debt bomb he's referring to. Would you agree with Wahid, or do you have a different take on this, Eric?
Well, so I think there's another component to what Wahid was saying, which is that the tax receipts are also obviously going to be deteriorating in a deteriorating economy, right? And when the economy was booming, the tax receipts were booming, right? And so there's going to be just a shortfall in tax revenue for the government, right? Which I think is maybe going to force the Fed's hand to relent earlier than they maybe wanted to. Just going back to the point about markets markets pricing the rate hikes. So yeah, so if you look at like the market implied Fed funds rate graph versus just the Fed's dot plot from mid-December, markets expect the Fed funds rate to rapidly decline over the course of 2023, right? But the dot plot expects a much more gradual decrease, right? Well, the chickens come home to roost when the deficit has to be addressed, right? And so we'll see if that forces the Fed's hand. I would point out one thing though, and this is just like a historical observation around Fed behavior. The Fed, of course, is backwards looking, but the Fed generally gets what the Fed wants. And so I think what my sense is what Powell's going to do, and I think it's also important to keep in mind, Powell's not an academic, right? I mean, he's a lawyer / private equity guy. I think he's probably more practical, but he's also probably more politically pliable than, for instance, like Volcker was, right? And keep in mind, Powell tried to hike rates, right? And he did, and then the repo crisis happened 2015ish, and he had to slash them back to zero. But Powell's focus, and he said this multiple times, Powell's focus is core CPE services ex housing, right? And if you look at that rate on a 3-month moving average basis, annualized, it's 2.5%, right? So I think to the point about accepting higher structural inflation, I think that's probably true. But I think rather than just saying, okay, because the Fed published the 2% guidance like in 2019 or sorry, like 1999 or something. It's pretty old. What I think they might just do is just find ways to measure inflation such that it's 2%, right? I think it's the measurement methodology probably changes to where the systemic inflation is actually higher than 2, but the way they measure it just resolves to 2 is my sense for how they sort of reconcile these two sort of distinct forces.
I'll go to Fried and Wizard. By the way, Isabella and Chadwick, you're welcome to jump in or put your hand up anytime you would like to speak. If I know it's the first time on the panel, but we'll go to Wizard and then we'll go to Fried.
Hey, what's up? So, I think the debt issue I think is a little bit different than, at least I have a different view. I feel like the debt thing is just like a great talking point for a lot of people because it's just so enormous. But I actually think it's not like an issue at all. And like as a macro portfolio guy myself, like I have never considered the debt problem. Like I think they should be printing more. And reason being, if you look at during this entire crisis, like the number one hedge against inflation worldwide was the US dollar. Like the only thing that people were like hedging themselves were, and they couldn't get enough of it. So it just, if you see the DXY exchange, index, it went up like crazy, right? And the reason was because it really is like the best asset or the greatest asset for people right now. Now you can say people should be buying other stuff, but the market considers the US dollar as the safest and the best.
So Wizard, I like your take on this because most people do follow the bandwagon that debt is the debt bubble's bad and this is not sustainable.
Yeah, I don't think so at all.
But I've had a lot of economists come to me privately, like, Mario, this argument is flawed, and I wrote a whole thread on this. I've never ended up tweeting it. And they explained to me why. It's very, very complex if you start digging deep into it and understanding it. But I would like you to explain as briefly as possible for the audience what that debt bomb is, and then why you think it's not, because everyone knows why it's concerning. It's very easy to have an argument that debt is bad. It's a very easy argument to make. And it's a very easy argument to make on why the US dollar with the quote unquote printing is going to depreciate in value. But you're making that counter argument, which is great because I wanted someone to do that. Because obviously so far it's not proving to be true. The debt bomb has not exploded. It's been every year is going to be like, it's going to explode this year. And it hasn't exploded since 2008. And the US dollar is still the best hedge. So I'd love you to explain what the debt bomb is, and then why aren't you concerned? Why is it not as bad, in your opinion, as bad as many people make it out to be?
Sure. So people have different definitions of what the debt bomb is. Most people will consider it as the interest that U.S. is paying on their debt is higher than the revenue they're taking in. So I think it's like last I saw it was like maybe 800 billion they paid in interest this year, and the revenue we get in was like let's say based on taxes and GDP is around 5 trillion or something, and they're saying that will obviously at some point that will get higher, but again. I don't think any form of definition of debt bomb kind of means anything, and I'll tell you the reason. My personal reason, and this is for 15 years of like bond trader. So U.S. government debt is my expertise. That's my portfolio been for the last Wall Street, pension funds, hedge funds, everywhere. So this is why I think the debt bomb doesn't matter or anything with debt doesn't matter because there's no way for the debt as US dollar to be the best hedge for inflation or be the safe haven until you find something else, right? And now people will be like, okay, maybe Bitcoin. Okay, that's not even, there's not enough of that, enough outstanding out there for people, for countries to buy. Chinese currency, there's nobody, no pension fund, no a sovereign fund out there that's going to replace US debt with Chinese debt, because A, there's again not enough of it. B, Chinese buy more of US debt than they do their own. So until there's an actual replacement of the outstanding US government bonds out there, there's no way for to be any issue. And the closest anybody is, you could say, is China. And it's like maybe like they have 50 years to, like, maybe after COVID, all the issues they have with COVID over the last few years and how bad the economy is right now, that 50-year timeline is probably maybe 75 years now. So there, in our lifetime, there's literally no concern, in my view, that the debt matters at all. And I think they should 100% print more.
So,
But
Wizard,
rates
you're,
right now, like what 3% 10-year rate? That's like nothing.
you're talking about no problem whatsoever with a debt bomb relative to other currencies. I agree with you. They all stink. I agree. But how could you possibly say it's not an issue if your deficit keeps ballooning up? At some point, at 4 to 5% interest rates where we are today, right? I mean, do the math. If you're at 31,
No, but it
32
doesn't
trillion,
matter, right? Because all that matters is relative. Like as an investor, like maybe in some philosophical way it might matter, but when it comes to dollar, the only thing that matters is what would I, if I don't buy the U.S. debt as, so who are the biggest buyers? Who are the biggest money drivers around the world, right? It's
let's go through that right now. Let's go through the
So
supply.
pension funds are the biggest, sovereign funds and pension funds, essentially. And the sovereign funds are basically pension funds at the end of the day. So think about guys like, California pension fund, like the biggest pension fund in the world. Think Norway, think SAFE, which is the Chinese holding.
Think sovereign funds, China, exactly.
Exactly, right? So these are the biggest ones. Norges Bank. They all would need, their like portfolio is around 50 to 60% US debt, right? They would need a replace, and they can't buy enough of it. Like there's auctions every day on US debt, like in the billions, and almost like half the time they end up coming through or tail. So tail means that people are willing to, they want more.
No, very familiar with that. Mm-hmm.
Yeah, and go for, just for people in the audience, if an auction tail, so every day the U.S. government auctions different maturities of debt. So whether that's 1 week, 1 month, 2 weeks, 3 months, 2 year, 3 year, 5 year, 10 year, 20 year, 30 year, right? And there's never been an issue with ever filling out an auction. Second, even in even in COVID times, there was no issue. Like think about 2008. Even then, there was no issue. What happens is sometimes people will just ask for more yield. So hey, you have to give me more rate because maybe the market's doing really good, and we want to be in equities or crypto rather than be in bonds. And when the market's doing really bad, we would rather be like, listen, I want to be in a safe haven. I don't care if I get 0.1%. I want to be in U.S. debt. So when it comes to that's the reason I think that it doesn't matter. And all that, the way the metric you should look at is there anything else relative that you can have? And if there isn't, then there is no concern about the debt, because they could just print. They have been printing more for the last 20 years, and there's still the insatiable amount of demand for U.S. debt, and U.S. dollar is just unreal. So until some other country comes up with a better, bigger army than U.S. and be like, okay, we're going to take over and annex the U.S., there's no concern about the U.S. dollar ever be going away.
Wahid, do you want to respond before we go to other panelists?
No, I agree 100% with the code word, just forever printing, which is exactly where I always go, which is why you want to hold real assets, hard assets, real estate, gold, silver, some forms of crypto, the ones, of course, that have value and utility, and all that. So so basically we've got two choices, and I've always said this, and I agree 100% with Wizard. We either go by the Stone Age, right, and completely implode, which I don't believe, or we're going to have structural inflation till infinity, and you want to be, you want to actually have loans, okay, and you want to be long real assets.
But why?
Yeah, just one thing. You said gold. If you have structural inflation, if you have inflation go up more and more, gold gets absolutely destroyed too, because gold is basically like a real yield bond, right? So like a zero coupon maturity, infinite maturity bond. So that's one of the reasons gold has been going up a lot, is because it's because real yields have been real yield bonds have been moving up. So that's basically, if you look at the U.S. government, they issue a thing called, so real yields are basically your nominal yield. So, say like 10-year interest rate is say 3%. You subtract the inflation from it. And that difference of inflation is basically what the yield you get on a gold, like if you buy like an ounce of gold, is basically like buying a bond, a U.S. government bond with infinite maturity and zero coupons. Like if you actually price it out, it ends up being net of carry the price of gold. So that's why gold is actually a great investment, 100%. As inflation comes down, especially real yields as they come down, gold is hands down. Like I've been literally shilling gold every day in my like newsletter, Discord, everything. It's because gold and silver. I mean, silver is more risky, but gold hands down is one of the best investments to have if you want something safe. And it goes along with as dollar weakens, gold will go up. So I think I agree with you.
I do, Jim. I'll give Mike the Jim in a bit. This Wizard in a bit as well. I want you and Simon to comment on crypto and tell us how you think all this will impact crypto in a bit. Not yet. I want to get other panelists to speak. But before going to Jim and then Fried and Chadwick, I've got one more question for you, Wizard. So just to conclude your statement earlier, and I'm going to oversimplify it for the audience, for anyone that's not deep into this, is that as long as the Fed keeps printing, then we're not going to see the debt bomb be an issue, or at least unless there's an alternative to the US dollar and US debt. Is that a fair statement?
Yeah, I think that it doesn't matter Fed printing or not. I think all that matters. I think the debt bomb is just a great like a talking point to like get normies all scared to buy like random shit. Personally, I think that there's no such thing as the debt bomb. I mean, at least as an investor, it's completely irrelevant.
And for anyone listening, I want you to watch a video by Ray Dalio called How the Economic Machine Works. It really simplifies this in a really cool short video. How the Economic Machine Works by Ray Dalio. It went viral a couple of years ago. Jim, I'll give you the mic before going to Fried.
Yeah, I was just going to say to Wizard, I mean, your analysis of debt is good on a provisional basis, particularly in the 90s and 2000s, and maybe even more so in the 80s when we didn't have nearly a relative problem like we do today with debt. But what we learned in the last 2 to 3 years is that the Federal Reserve is totally willing to go along with massive upticks in government spending, both that which comes on an acute basis, as it did through COVID, but also in massive expansions that were happening during the Obama and into the Trump administrations. Now that the chickens come home to roost on that over time. Like your analysis is at best a provisional one as it relates to debt, and it works in certain scenarios when you also know that you're in a place where debt's going to roll back down, as it was, for example, during the Clinton administration. But we have had a post-war growth of debt in the United States, and this affects everybody, not just the United States. We've had a post-war growth of debt unprecedented in Western history, even. In fact, we've never seen this kind of debt go the way it has, except in wartime and with periods of pay down. Like after World War II, American debt went way, way down through the 50s and 60s, even though we still had debt issues that came after that. But it actually went down. There's no time in the near future when that changes. And so your analysis is not going to work in the long run when it comes to debt because of the new foundation we have built over the last 10 years. And there's absolutely nothing on the economic horizon that changes the scenario of increasing debt. That becomes a problem, and you just can't pay that down over time.
Yeah, but that's the big. So agreed. I'm not disagreeing with what you're saying, and I agree that spending in America has gone up significantly. Obviously, COVID did not help as well, and Social Security and so on has increased spending. But once again, I think
too. Like this is huge stuff.
Agreed. But if you look at the larger picture, it's actually not that bad. Like it's actually really funny if you see it if you're not like deep into the bond market or into the debt market. It seems kind of ridiculous because like the government prints 3-month bills and like debt and 1 week debt to pay 2 year debt, and then they pay 1 year debt to pay 10 year debt. So if you like, there's so many arguments that can be made that this is all like just a big Ponzi end of the day, because you're just issuing short-term debt to pay long-term debt, which nobody even made that argument yet. So I will against myself. But in the grand scheme of things, and if you just look at the debt structure as a whole, the capital structure, how the bond market moves, how population has increased, how technology has increased, it actually isn't that big of a difference. Like, yeah, it is, debt's definitely increased, but relative per capita, it's not like that crazy. But it's way easier to get debt today for like even like a regular person than it was like 10 years ago, right?
Is per
So that's
capita
gonna
the best
end up
comparison there? What about debt to GDP ratio? Like, that's a huge.
Sure. I mean, but again, it all comes down because you have to kind of normalize everything to population. You have to find a proxy for growth of technology and proxy that to the debt. I mean, it's not like a very simple like the way I'm not saying you're wrong. I'm just saying the way you articulated it, it's not that simple. But net, again, for me, it's not very philosophical. It's very like, listen, I'm just in it to make money. And as an investor and a portfolio manager, I see no concern, and nor does, clearly the numbers show no investor or, whether you call it sovereign fund, hedge fund, anything. Nobody has seen any concern with the debt in like ever, right? I think maybe if you go back to like maybe it was the 70s or 20s, the U.S. government issued like I think it was silver-backed bonds or gold-backed bonds, and they were just like, oh fuck it, we're not gonna pay this back. Other than that, like there's never, I mean, that also was kind of like a semi kind of bullshit. But other than that, there's never been an issue with U.S. debt, other than just great talking points.
I want to go to Chadwick. You've been waiting for a while, man. Chadwick, you there?
Yeah, I completely agree with what Wizard's saying. There is no other game in town really, apart from the U.S. dollar. I don't know when another reserve currency or another asset class is going to pop up that's going to replace that. And Powell is definitely part of the industry, right? So Powell is not going to jack the rates up too high for a number of reasons. I think we can make the argument that mortgage policy and the amount of Americans who hold mortgages and the amount of mortgage lenders out there want rates lower. If Powell gets out of control, if the FOMC gets out of control with rates, we'll have a stock market correction as well as decay in the housing market. And then the last thing I wanted to say is, yeah, it does seem like we're printing money uncontrollably. But if we get back down to a low rate atmosphere, falling interest rates make debt cheaper.
Fair point. Fried, I forgot to go to you earlier. Go ahead, man.
Yeah, I think there's it's coming to a point where, 25 basis points today. If we get another 25 next month, we are at the terminal rate, if not over the current terminal rate. Jerome Powell admittedly has stated that they have no clue what they're doing, in the sense that they do react to lagging data. So they have said for months now they're going to hold rates higher for longer. I see a situation taking place where, rates will exceed the current terminal rate. I feel like interest rates in 2023 will get closer to 6% for the Fed's fund rate. I think this would then take the headline CPI number below the Fed's fund rate, having us, the United States would then have positive real rates. If they pivot, that is inherently and historically bearish for U.S. equities. Every time during a hiking cycle that the Federal Reserve has turned and pivoted and started cutting rates down, very bearish for U.S. equities. I think this.
Hold on. Sorry. Yeah. So Fried, just sorry on this particular point. Can you elaborate on this? So what you're saying is that when the Fed pivoted from being hawkish and started cutting interest rates, that's actually bearish for the markets? Don't we see a massive rebound in risk assets?
No, historically during these hiking cycles, after cuts, now will there be bounces back after that? But I mean,
sorry, maybe I misunderstood. It becomes bearish once the hawkishness stops. So once they start cutting interest rates.
Correct. If he was to announce today, this is the last rate hike, I do think the markets would roll over for a bit before heading further higher. I don't think it would just be like, okay, we're going into a deep depression now type of situation. I do think, with this being said, if they were to get inflation to a 2 to 3% and keep it there, they need positive real rates. And I think if they began to cut and easing, you would see another spike in inflation. And this has kind of been my base case for a while of, the Federal Reserve reacts to data, and when they react, they typically go overboard. And I could see a situation where over the next decade, we see massive peaks and valleys of inflation, where we see big spikes over a couple year period down to big, right now, this year, we seem to be dropping the CPI rate. And I think zero interest rate policy. What's that?
Before you continue, Fried, Wizard, I saw you put your thumb down when the earlier point that I commented on with Fried. Can you tell me more why you put your thumbs down on that point?
Yeah. So I see that there's a very popular chart that's been going around for like the last little while that shows the last, I think, 3 or 4 hiking cycles all the way back to the 20s when they pivoted, the equity market collapsed. That's not because they pivoted. It's more a function of what was happening in the time. Like, for example, in the 20s and 70s, market drop is because we ended up in a deflationary depression, especially the 20s. So that is kind of what the biggest concern for the market is, and that's why the market's saying that the Fed is actually going to slowly pause and move to cutting rates, even though they've said they won't by end of the year. I don't think the market's going to crash if they announce today that there's no way. I mean, if you look at, like, for example, short end options are pricing in an 8% probability of them being dovish, which means that if they end up actually saying anything of that sort, you'll see like a 5 to 10% rally in NASDAQ like within the hour. And the point though of what he's saying is, what happened in the past, there's something to be very careful as traders and investors, because I've seen this chart go around a lot, and I've seen a lot of people talk about this. And me and a bunch of my friends, we all manage regardless how much money we manage, it's been like a laughing point. Like, I don't understand why people think if they're going to pivot. And it's all retail that thinks that, and it's very confusing. But the reason is because, on that chart, if you look at the last, first of all, the data points are like 3 or 4, so there's not enough data to even make a claim like that. But yes, in the past, during hiking cycles, when they did like in the 2018 hiking cycle, that happened because there was taper tantrum. There was like a very underlying reason. In 1970s, it happened, again, very underlying reason. It wasn't because they pivoted. It was because we were approaching a deflationary depression. If we approach a deflationary depression again, then we're going to crash regardless of pivot. It just happens to be around the time, because once we start getting into a deflationary depression, the Fed's going to be like, shit, we fucked up. We got to cut. So
yeah, and I really believe that there will be a credit event causing the pivot in 2023.
So the absolute way for the Fed to pivot, like hard number, is 5% unemployment. If we hit 5% unemployment, I mean within like a 0.1 to 0.2%,
what's the unemployment right now?
They will pivot. 3.5 something, or maybe lower, like around that much. Like, that's a hard pivot, because that's the second mandate of the Fed that they have to uphold, is max employment. So if that, or the other pivot is if wage inflation goes down to 2%. Those two are the pivots. Like a 5% unemployment is a hard pivot, like for sure they'll pivot.
Okay, before we continue, I do want to tell the audience about half an hour left before the decision is made, and then we'll go through the Q&A, and we'll go through the 5-minute speech and the Q&A, which everyone waits for, to see how what their policy will be moving forward. But I want to go to Eric, and then we'll go to Simon. Eric, any comments on what was said so far?
Yeah, so I really enjoyed Wizard's overview and perspective on the debt topic. I agree. I think the idea of a debt bomb is kind of like a Malthusian construct, right? I mean, it doesn't account for innovation, growth and efficiency, technology, that kind of thing. And the U.S. dollar doesn't have to be perfect; it just has to be the best and the best haven. It's kind of like that story about if you see a bear, you don't have to outrun the bear; you just have to outrun whoever you're.
But just to confirm, Eric, I want to confirm before you continue. You and Wizard are saying something very important. I want the audience to kind of question what they believe, because it's become a common narrative, and I've seen this on Twitter and off of Twitter. is that the US dollar is doomed, the debt bomb is about to explode, and the economy will just come down crashing. It's just a matter of when, and that's been that's been the narrative for since 2008, at least for me. So what you're saying here is that
It's
this
mostly Bitcoin maxis who say that. Just you're
even
following too many Bitcoin
no, even
maxis.
outside that, I wasn't in crypto obviously in 2008. Even before that, the debt bomb. You can see, Jim. Would you agree that this is a common narrative? I'm not saying it's right or not. Just Jim, would you agree this is a common narrative that you see as well, Jim, or no?
I kind of think that the debt bomb argument is a little bit of a red herring here, but there is a debt issue. It's not related to can we make payments on the debt in the United States, which would fundamentally harm the U.S. dollar as a finishing currency around the world. Excuse me, but I have a different take on the debt, which I'm not going to share right now. But no, I don't. I mean, a debt bomb is a narrative. I just don't think it's really what's at issue here.
Okay, so I think people in the audience, I'd love your take before I give the mic back to Eric. Just go back in the bubble in the bottom right corner. Are you worried about the debt bomb? Is that something you've seen and you've asked, you've had concerns about? And what's your thoughts on what was just said now by Wizard and Eric? Go ahead, Eric.
Yeah, well, so one thing I'd rather sort of hover on the sort of practical implications here, which I talked about before. It's like that might force the Fed's hand, right? Because you've got you can have a shortfall of tax revenue, right, and you can have a deficit that you have to address, right? As well as the debt payments, I think, are less of a structural forcing function. But I think one other thing that we haven't talked about is kind of like the geopolitical lens that you have to kind of funnel all of this information through. And like, there's two kind of components, a couple components to that. One is that, Wizard talked about the largest holders of U.S. debt, but they're not buying as much anymore, right? Like Japan and China have slowed down treasury purchases. I think the other thing though is we're my sense is we're entering from a geopolitical standpoint, we're entering a period of deglobalization, or we might be in the midst of like the early innings of a period of deglobalization, right? And deglobalization is itself inflationary, and globalization is deflationary, right? Because you allow open free trade to imbue various regions with competitive advantages for production, and that those advantages percolate throughout the sort of global economy. And we're seeing this now as a result of COVID policy, right? We're seeing this now, deglobalization. We're seeing it as a result of COVID policy, different domestic approaches to taming COVID. We're seeing this as a result of the war in Ukraine. And if we do see the sort of like global supply chain network, the global trade network, fissure and fracture into sort of different sort of sub networks, that could potentially bring the debt bomb into sort of like more of a central focus. But I think, like, as we stand now, as the world exists today, no, I don't think the debt bomb is very relevant or important to think about.
Yeah, but I think the jury's still out on whether globalization is going away. We definitely have, we have a few innings of a challenge there, but the reason for that is because of how trade policy has gone, which is substantively this: the United States says, hey, we want to trade with you. Oh, okay, and thanks, yeah, we'd like to trade with you, but don't touch us. Oh, okay, we don't mind that because we want to have trade with you. And that's playing itself out now, particularly with China. So anyway, but it also shows that the way globalization has gone, your analysis of what globalization does in terms of inflationary pressures is accurate, because you go out and you find more efficiencies in a broader area, particularly when it comes to wages and that sort of thing, and productivity. Of course, it's a productivity negative, by the way. Globalization has been a productivity negative. But that aside, this is all true, but it really argues more for the Fed getting the freak out of the way and going back to a gold standard, being a gold standard kind of guy. But because that's where you get a better situation monetarily. But the monetary playing around with things, globalization or no, is, in my estimation, a far more dangerous thing moving forward than how globalization is going to play out over the next few years. And I predict there will be some fracturing, but we're going to go back to globalization within a couple innings, in my opinion.
Yeah. Simon, good to have you back, man. Been a long time.
Hey, thank you. Yeah, been a while. So I'll take the US dollar is doomed. It's obvious the US dollar is doomed because every fiat currency is doomed because none of them have ever survived in history. To think that there's something different about this empire is just the fact that none of us have been alive in a change of
But it's the
empire or a
question.
change
The
of world
question.
reserve
The
currency.
question is when? Is it now? Is it next decade? Is it in 100 years? Is it in 200 years?
Well, you know you've got to look at the geopolitical. So that was brought up that when America decided to sanction the Russian central bank, that slowly had a massive decrease in the utility of the US dollar as a world reserve currency. When you think that your treasuries can be deleted based upon geopolitics, and they can because they're just database entries at the end of the day, then that is concerning for a country like China. So to say that you can continually print money defies history. So you have to ask yourself, why would this be a defy history moment? Now, getting the timing right is always the hard part. I believe it will be in our lifetime. I have no doubt about it that we'll see that in my lifetime. I'm 43. I intend to live to about 100 if I can. But I think we'll see it in the next couple of decades. But I think I'll push back a bit on what Hussein said, because I subscribe to a similar philosophy, but I believe that there is a third outcome, and that third outcome would most likely be the demise of the dollar. So if you look at the systemic effect of the inflationary cycle, or the desire to prop up the markets by increasing debt, you can only end up in a rich poor divide, and the rich poor divide always creates the conflict. So increasing interest rates is okay for people that can afford that, but when you've got real estate prices at record highs and increasing interest rates, then that's asking for the recession that drives the wealth from those that can't afford to pay their mortgages to those that can sustain the higher interest rates. So it's simply a cyclical movement of redistribution of wealth that slowly enters a cycle where you have geopolitical and issues like we experience today. But then the third alternative. So I think he said a dystopian future where we let the dollar crash and we enter into a zombie apocalypse, or we accept systemic inflation. Well, what the dollar needs to save itself is most likely the same money supply but deleveraging. So how do you achieve that? The way you achieve that is you wait for a financial crisis like 2008, and you replace debt-based bank money with a central bank digital currency. So you allow everyone to download an app with debt-free money, just like all the America-funded wars of the past when they couldn't borrow the money through the bond markets. And so the technology is the third alternative that changes things right now. And so what is the cost of the government or the central bank printing their own money rather than backing it by debt through a bank? Is that you remove the American dream, you remove what made America, you have a slow removal of the capitalist ideal, and you have a tighter and tighter government control. But the bigger trend is that I don't believe, I have no doubt in my mind that over the next 10 years, artificial intelligence is probably going to be more important than a government. And so when you have central bank digital currencies, a technology-led economy, a decade or two where artificial intelligence become more important in the world than a government influence or control, then you have algorithmic artificial intelligence-led central bank digital currencies competing with something like Bitcoin and gold in case there's an internet failure. But I think the trends are all that the next world reserve currency will much more likely be artificial intelligence-led monetary policy that optimizes for the specific goals of each region, where robots and machines are more intelligent than humans and central
But
bankers.
Simon, is that even possible
yeah.
when governments want to meddle into this? I mean,
And
Governments won't have a choice. A robot will be able to process information at a pace that no human can imagine.
so
Humans don't have a choice in this matter.
yeah, but the government
Like we're already
will meddle
seeing the
in,
rate.
I want to
right?
go back, guys. I want to go back to Simon. What do you expect to happen in the crypto market for all the crypto peeps in the audience if we see, let's say, the Fed taking a more dovish stance and then just a 25 basis point increase moving forward?
You're talking short term.
Yeah, short term. What do you expect? Because I think a lot of people,
Yeah, so
because you've given us a great overview long term, but over the next, let's say, for the rest of the year, can we see, just for crypto and then obviously for the macro economy, but for crypto, can we see a massive bounce back, a quick recovery, and a bit of a pump for the rest of the year?
Yeah, so
And then what you say, sorry,
just
so I'll just
follows.
add, sorry, one last thing, sorry, Simon. I'll just say, whatever you say, he will likely apply to other risk assets. So I'd love your take on this. I do want to go to Isabella and Wizard because we're getting closer and closer to the decision. We're minutes away.
Okay, sure. Yeah. I mean, crypto will just follow Bitcoin. Crypto has always followed Bitcoin. So whatever, Bitcoin's the only thing that's important in the macro sphere, and everything else will follow. Bitcoin will just follow at the moment like a stock market short term, which is if the Fed does something that's out of line of expectations, I think everything's priced into the market already, and so everything's priced into Bitcoin and priced into the stock market. But if the Fed does something that is out of expectation, then you can expect a reaction from Bitcoin, which will create a reaction in the crypto markets, which would be the same reaction in the stock markets. A little bit more longer term, obviously the halving cycle and the fundamentals of Bitcoin's fixed supply prevail.
And just one thing I want to note, and correct me if I'm wrong, generally the Fed doesn't like to move too far off market expectations. They don't like to surprise the market. But again, you can correct me if I'm wrong there, and we can go to Wizard.
Yeah, markets only move when the Fed surprises the market. So what are the expectations of a 0.25% hike is priced into, that's priced into the market right now. So you wouldn't expect much of a reaction unless they deviated from that.
I'll go, actually, Wizard, what I'm going to do is I'm going to go to Isabella. I know her hand's not up now, but it was up earlier and maybe went down by itself. So Isabella, I'll let you jump in before we go to Wizard.
I mean, there's been a very broad discussion and I have many views, but is there anything specific that you want me to comment on?
Yeah, I think the first one will be great because we're going to continue discussing all this after the decision is made and before the Q&As. So the thing I'd like you to comment on is more what your expectations are in 20 minutes, what the decision will be, what their stance will be, and how the markets you think will react. I know this is speculating, but from what you know now, and I'm not sure if the Fed whisperer gave us any hints.
So, I mean, as we've been saying, the 25 bip rise has been very much priced in. I think it's one of the most consensus moments in the market. It's not been more consensus for a very long time in terms of the polls and forecasts. So I fully expect it to be 25 bips. If it was to go either way, I think, I mean, it's not going to go down. It might go higher, but I think that would very much surprise the market. But I think the bigger question is, and there's also been a Fed committee reshuffle in the last, since the last meeting. So we've lost 4 hawks, and we've got 4 more dovish members come in.
That's great
so
news. That's good news.
Yeah, so this could make a difference. So now we've got, I've got my list of the dudes who have come in. So yeah, so we've lost Bullard, we've lost Esther George, Loretta Masters, and Susan Colling, and now we've been replaced with Austin Goolsby, Patrick Harter, Laurie Logan, and Neil Kashkari, who is famous from 2008.
So that could influence. So what you're saying is that could influence the decision in being, or at least their stance in being a bit more dovish.
Well, I think the the big issue is what's going to be said post facto. So I think everyone is expecting 25 bips, but the market will respond to the comments and any indication that the Fed is going to pause more quickly than expected, right? So if there is, it's not so much the amount of rate cutting, it's how quickly it's going to pause, whether it's going to be paused more prominently than
Makes sense.
I mean, so if they stagger it over the year, I think that's what people want to know. Yeah, but I think in terms of the dollar bomb and the debt bomb, etc. I mean, these are kind of very polarizing questions. I think you were right to say that is a narrative in the financial sphere. I mean, in the crypto sphere for sure, but beyond that, I think it has become more normalized to talk about the shift away from the US dollar as well. I personally don't think the US dollar is going anywhere anytime soon, but I do think we're possibly going to enter a more complex environment. And certainly you've seen gold buying by central banks go up in the last quarter a lot, and that's mostly non-Western banks. So this is going to have an impact. So you've got also one thing you can think of is, where does this debt, why does this debt exist? It exists because of the trade imbalances in the system, right? So if for as long as these countries that are export oriented and power themselves on generating essentially surpluses through exports, that's going to be maintained. That's a product of globalization. But in a geopolitical context, if we do end up having more acrimonious relations with China, etc., then that poses a real problem. I doubt the dollar will disappear, but it might get more polarized. So we will see, the big question is demographics and whether China starts consuming more domestically. And that is going to be the big question in the next few years.
Cool. I see Joa in the audience agreeing with you. Wizard, jump in. And then I've got a few questions from the audience we can sneak in before we hit the clock.
Hey, yeah, I'll just give my views on the Fed.
Yeah, I'd love. Yeah, if you can
reaction.
give us a comprehensive overview of what you think, and I don't know if Wahid's still with us, so I'd love your view, and then we'll go to Wahid on what you think the decision will be, and what their stance will be, and how the markets will react, what people could expect today, next week, and the rest of the year.
Sure. So I'll just go through the scenario. So right now the market's pricing in a potential hawkish guidance in the conference. 25 basis points this month, next month. It's around 48 basis points total, I think, last I saw for 2 months. And then cuts in the fall. I think it was September, October were the first cuts. Fed is obviously not said that they will do any cuts. They've actually said we're not looking for cuts anytime soon. But they are basically going, obviously data dependent. I think today the different scenarios are a very, maybe 1%, I think it's 1 or 2% probability that they go 50 basis points. Obviously the market will correct very aggressively. You could see NASDAQ sell off at least 3% ish. I would think 3 to 5% ish. If they give guidance that they're, again, that's a low probability. If they keep it on the nose, it won't matter. The thing to look for will be the dot plots. So if they change the guidance on the terminal rate, like their projections, that's what was a big shocker in the last one, is where they increased everything, and you kind of saw the market take a pretty big hit in December on the back of that. So the dot plot will be important to see. So obviously, if they keep it on what it was last time, which was I think 5 to 5.25%, then I think that's it's a non-event. If they increase it, obviously markets are going to, correct. I think you'll see at least 3 to 5% in Nasdaq correction. Then Bitcoin, just add another 2-3%, and Ethereum another, maybe 10% lower. If they come in dovish, I think all the risk is actually to the upside, because market is obviously pricing in all the pundits, everybody is saying they're going to come in hawkish and be aggressive and bring the wood chipper like he did at Jackson Hole 2-3 months back. The dovish is the bigger risk. So if you don't have long risk, if you're not in a position where you can get the upside, I think you're going to see a lot of people kind of buy aggressively. And this is what happened in his speech in December ahead of FOMC. He kind of changed his tone in FOMC, but the speech he gave at Brookings Institute was a little bit not hawkish, which was considered dovish by the market. So if you see not hawkish, I think we see a 1.5% to 2% rally in Nasdaq at minimum, which will result in 3 to 5% on Bitcoin very easily, and just obviously low liquid like Ethereum will be another probably break 1700, 1750. If he gets dovish, which again is just as low probability as them hiking 50 basis points, then obviously you'll see the same opposite reaction. You'll see a pretty significant rally. I think what's going to be bigger actually is not even the meeting. I think he's going to just talk. I really think he's just going to talk about just saying that, hey, we need to keep rates higher longer. We like that goods inflation is coming down, but we think that wage inflation still has a lot of work to do, and we're going to keep rates higher. I don't think he's going to say flat out that we're going to hike 25 basis next month. I think he's just going to give guidance that we're not looking to cut anytime soon or pause, but we do accept inflation is trending lower. So he's going to basically do 25 basis points next month as well, which is priced in. If he gives, the bigger risk that the market's actually worried about is a hike in May. So if they start giving guidance on that, but I don't see why they will. But if they do, again, you'll see market come down another 1.5% to 2% at least if they do that. But I think that's very less likely. The other bigger thing is he's going to talk about being data dependent, which is going to put all the focus of the market on Friday. So as I said, that's the bigger number. I think that's a way bigger event than FOMC. Because he's looking for that. He's looking for wage inflation coming lower. That sent the entire market up, Bitcoin up from 15K to 24K almost, right? Wage inflation coming down in January. So I think the number on Friday is going to be way bigger than FOMC is. And that's personally what I'm kind of looking forward to. Obviously, that wage inflation number comes lower. You're going to see the next month all risk markets rally across the board. Obviously, if that comes in higher, then I think you slow down. You'll just kind of grind and consolidate. Long term, my views are if I'm very data dependent myself as well. I think inflation is trending lower. I think if unemployment increases or average hourly earnings come down over the next 3 months, I think we achieve the rare scenario of soft landing that the Fed has kind of been looking for. That's kind of the best scenario we can look for. Then Fed probably will not have to cut, or they can hold rates at a higher level longer, get inflation down. At the same time, wage inflation comes down, labor kind of holds. Then you should see risk markets rally between now and end of the year. I would say, we should definitely, I would say 4,200 on S&P should be definitely achievable. Obviously, if we get to a scenario where we end up in a deflationary depression, so if they end up hiking more and unemployment rises, then we'll end up in, we'll probably see another at least 10 to 15% lower in stocks and, probably test the lows on Bitcoin, Ethereum, all that. But I think that's a very, very low percentage.
So you're saying,
I think personally,
you're pretty confident the worst is over, in your opinion, was it?
Yeah. I've been pretty strong on the rhetoric that the high in rates is in, like 10-year rates. I think was in like whatever, like November, October, November. I think peak inflation is in. I think that was 9.1% in June. I think we could see like a double move up kind of thing, like a little move up and then back down in inflation. Again, less likely. I think we're just going to trend lower over the next 9 months. But yeah, I think the worst is behind us. That's not to say that the Fed can't make things worse, because it's one man's say basically. But those are my different scenarios, and that's kind of how I'm positioning my portfolio, trying to be very data dependent. So right now, in today's number, I'm going in small long. I have straddles on QQQ, so Nasdaq options. I'm long gold. Obviously, I'm long crypto, but I have VIX options under 20. So that's kind of going into it, and obviously based on what happens, I'll readjust my portfolio pretty aggressively.
Wahid, your thoughts on what the decision will be? How's your portfolio? What's your portfolio like, and what can we expect to see in the next few hours and next few months?
Yeah, so I don't like the market setup in immediate term right now. So I go back to the summer where I was really built up. Felt positioning was extremely light, so really liked the last 6 months. I think we rallied a little bit too hard recently, and basically what I don't like is what the market is basically discounting, which is a very rapid pivot, a very rapid decline in interest rates relative to where I think these guys end up. I actually think the market is correct that we're going to slow down faster than people think. But unfortunately, there's this big reality in my mind, which is that these nincompoops only pivot when they break things. And they unfortunately need to break things in order for them to panic. That's when I think markets really bottom, and we're just not there yet, right? The market is actually calling the bluff. The market is having a good time. Things have really rallied hard. So, he'll just come in and try to be hawkish. I agree with Wizard. That's probably a little bit discounted. So maybe there's a little bit of a pop today because market is sort of worried about him. But just going into February and March, now that flows have sort of subsided, the huge 401k flows that are very typical in January, et cetera, the seasonality, I just think we are in for a bumpy road. And I really want to load up when these guys panic and capitulate. And we're just not there yet, right? I think Lagarde.
You've been waiting for a capitulation for a long time, Wahid.
Well, no. It's all relative to pricing. All relative to pricing, Mario. So when I was very bullish in the summer, remember that, it was because the markets were in death, right? They were like really weak. And I was saying, don't worry. They will eventually capitulate. Things will slow down. Inflation indicators will start to trend down, etc. What happened is the market over discounted a capitulation. We've rallied very, very hard. So I'm always mark to market where we are in the markets. Does that make sense, Mario?
Yes.
So when the market says it's doom and gloom and we're death, and I say, okay, we're in for a slowdown in inflation indicators, and things will get better. When the market is really overly discounting euphoria, I want to pull back the reins. That's kind of where I am right now.
So you think the markets are reacting too quickly, and a bit too bullish for your liking?
So I felt that they were really, really bombed down over the summer. I don't like how well now I'm positioned a little bit more neutral to negative, but I think we're in for one last shock. We need that shock for them to capitulate, start a new cycle, rates going down, etc. So the road to that, and then you layer on geopolitics and a second leg up in the invasion of Ukraine. I'm not going to spend time on that.
Actually, I'd like. So how big of an impact will geopolitics play on your predictions?
Well, I think in the next 2-3 weeks we're going to see things in Ukraine we've never seen before, with Belarus intervening, etc. But I'm not a geopolitical.
And that could, what you're saying is any developments there could have significant impacts on whatever we're talking about now, including inflation.
Everything. Okay, so the reason why I love this panel is because everyone here is a trader. I've traded my whole life, right? So everything's on the margin. Everything's relative to expectations. Where we were in the summer, you had a lot more strikes at the goal. Where we are.
He just dropped out at the worst time. Did he drop out? Was it me? Yeah. I just got a call. He got a call.
He dropped out.
No,
yeah.
He's still there. Is he still on the? Can you see him on the panel? Can you see him on the panel or no?
Yeah, he's there.
Yeah.
I got a rundown because it's 5 minutes.
Yeah.
To basically thing. I'm just gonna leave it one quick little thing. It's a little bit more philosophical from an investment standpoint. Every cycle I've seen, I've been in Wall Street since like 2008. Every time we have a big crash, people almost always miss out on the bottom. You'll never catch the bottom. You'll never catch the top. And people will always wait for the next capitulation. They'll wait like, oh, there's going to be more, things are going to get worse and worse and worse. If you don't know what you're doing, the best thing to do is find some good points of, DCAing. Start in with a 10% of your portfolio and just keep like layering down. Because trust me, it's very possible from here. All it takes is 2 or 3 data points to make a bear market rally in a bull market rally, right? If you look at 2009, I remember everyone said, oh, we're about to crash. They kept saying we're going to crash for 10 years, and we didn't crash till COVID happened, and that was a black swan event. So let's be, when it comes to investing, it's always good to get some risk in if you have some form of conviction.
What would
remember? Never make money.
What would change your mind on that particular point you just made now? Geopolitics?
I mean, I always try to have some risk, whether it's long or short. I react to, as the market moves. I mean, if I see like there's a big attack somewhere, war, yeah, I'm just going to go short like S&P futures or something like that. But it's, right now, listen, I mean, things were really bad out there the last 3 months. I mean, you had, especially in crypto, you had FTX crash. You had the biggest crypto hedge fund went down in June. I mean, I don't understand what more capitulation we need. We had all the exchanges, everything went down. So if you thought that 1050 on Ethereum or 15K on Bitcoin was not capitulation, and I don't know what else the world needs to end for you to buy. I'm not sure.
Yeah,
But
I agree with you there.
listen, I look right. Anyways, thanks again for this. Appreciate
Thanks,
it.
man.
If
We're
anybody
gonna
wants to hear my
yeah,
stuff.
sure, man. We're gonna be streaming it as well, streaming the Q&A in 30 minutes. If you want to drop by again, Wizard. Wahid, I know you chopped out earlier, so I'll let you continue what you were saying. You gotta unmute, Wahid. Bottom left corner. Otherwise, I'll go.
Oh, I hate
love
it when you're so facetious. Yeah, so I don't know where I dropped out. I was just saying I like a better setup. So it's all on the margin. And then I think where we're set up today, we have too much good news relative to what's out there.
And before we go to Friday and Isabella, Wahid, one more point. Just going back to crypto, I want you to touch on crypto very briefly. The point that Wizard made. Oh shit! It's in 2 minutes. Yeah, shit. We got 2 minutes, and then we'll be reading out the decision.
Ask me about crypto. What's that?
Yeah, very quickly, because I don't know. We only have 2 minutes before reading out the announcement. We've seen capitulation. Would you agree there?
Yeah, I said that in the summer. Absolutely.
Fried, very quickly before Nick reads out the announcement. Nick, you've got everything ready on your end? Hold on, Fried. Nick, you got everything on your end?
Yeah, everything's ready.
Cool.
It's
so
just, I mean, we'll know pretty much.
Your mic is muffled. So I'm not sure if you can make it clearer. Yeah, if you can make your mic clearer.
Yeah,
okay, cool. And then just jump in and interrupt whoever's speaking as soon as the announcement comes in. So you could read it out for us all. Fried, go ahead, man.
Yeah, I think moving forward for investors, people really need to be looking at, what were the benefits of 15 years of zero interest rate policy and quantitative easing, and a lot of money during that time period from 2008 till basically COVID, or now really, funneled into the S&P 500, where market cap didn't matter, value didn't matter. And I think now that we're not in a situation now, and looks like with the next economic cycle where zero interest rate policy is just, and quantitative easing can't be a thing because inflation will run out of control. I think between commodities, precious metals, and emerging markets, now that some of those companies in the emerging markets are a little more in favor and value oriented and not at extreme multiples, I think offer a lot of alpha.
Fried, one quick question for you, and Nick could interrupt us any second with the announcement. But one quick question for you: the debt bomb we were talking about earlier, that everyone keeps talking about, is that something that concerns you, or do you just call it a debt bomb fallacy, as Wizard mentioned earlier?
I think there's going to be a massive credit event causing a pivot within 2023. I don't know where it comes from or what sector. I think it will have cascading effects across markets, though.
Yeah, so the Fed has, sorry to interrupt, they have
all good, man. Go ahead.
Hiked interest rates by 25 basis points, so they're at 4.75%.
Just as expected. I think that shouldn't come to a surprise to anyone. And then what we look forward to now, it's in 30 minutes. What will happen, before going back to Fried, is, Wahid, correct me if I'm wrong, Wahid, but in 30 minutes, we'll have a 5-minute speech by Powell, and then we'll have a 30-minute Q&A, which is probably the most important, where we get a sense of their stance. Are they going to be more dovish or hawkish? Is that right, Wahid? Wahid, you're muted still. Go ahead, Fried.
Sorry, Mary, I'm listening to the announcement. Sorry,
okay.
I'm not focused.
All good. Go ahead.
Yeah,
Fried.
I do believe there will be some sort of credit event that is cascading across markets, forcing the Fed to pivot. The problem is, if they go to zero interest rate policy and quantitative easing again to bail out markets, then inflation will run out of control. And I think they would attempt some sort of a bailout in markets if there is another credit event. And that's why I said earlier, I see over the next decade massive ebbs and flows and peaks and valleys in inflation. And we could see an inflationary depression where asset prices crumble around us, but consumer goods, food, and everyday needs rise in value.
All right, we might be streaming.
Hey, Mario, can I break in?
Yeah, go ahead.
Can I break in? So the overarching story is they're not done. They're not done. They want to continue. Okay, they want to continue with more rates, and they'll take it as it is. So it looks like the market is now going to start discounting not just another 25, but potentially another 50.
Yeah, and I like I said earlier, I mean, higher for longer. The Federal Reserve has moved their dot plot and their terminal rate higher every single time, and they haven't stopped. I really think they're going to get positive real interest rates within 2023, which when we're talking about government debt, I mean, we're going to start seeing pieces of that government debt come to maturity and then start to be refinanced in a situation where maybe tax receipts don't cover the interest on the debt, which would be a technical default. And a little conspiratorial, this is why I think members of Congress are starting to push this tax on consumption. Maybe they feel they would be able to take in more tax receipts based on consumption of goods, not just on your income.
Wahid, anything? Wahid, are you with us? Are you still listening? All right, he's listening now.
So I'm just following the
Yeah,
news.
interrupt
what's
us.
the- what's the
Just
question?
interrupt
So-
us whenever there's updates from the news, like you just did. Okay, interrupt, jump in. And
No, it's just it looks like the terminal rate's rising. The easing at the end of the year in the yield curve is coming off. So he's obviously trying to send a message strong that we're going to be data dependent and we're not done. And terminal rate is closer to probably 5.25 to 5.5. Okay, versus where everyone was at 5 before the call.
Okay, Isabella, you got to unmute Isabella, bottom left corner. All right, Isabella, when you want to speak, I know you had your hand up. Just unmute bottom left corner. Simon and Eric, do you want to jump in on this one as I go through the audience questions?
No, cool to take some questions. I think it was all as expected. I think this was just going to be a predictable one.
The decision
I didn't
is
really see
predictable,
much
but I
of
think
them.
their stance is what everyone's looking forward to.
Yeah.
And that's what we're going to see in, we're going to start streaming in 25 minutes. So we've got one here. Okay, so maybe Simon, you'd like to take this one. We'd love to hear anyone speak about the macro horizon through 2030 regarding Peter's stance. Also, what about the fourth turning philosophy? That's from Patrick. And then we've got another one here, Simon, for you. I'm just having a look through them. Yeah, I wouldn't bother reading with the other one. Another one's asking about the debt bubble. Actually, I've got a lot of questions about the debt bubble as well. Seems a lot of people are worried about it. Simon, we saw Wizard talk about it not being a big concern of his, and talking about other factors playing a key role, such as technology advancing, productivity improving. Your position on the debt bubble, and when should we ring the alarm on the debt bubble, in your opinion?
Well, you ring the alarm now because they're not going to do anything to stop the debt bubble until the whole thing implodes. They're not going to control debt. They're not, and when it implodes is just, there's no way of forecasting that because it's always a black swan event. It's always a systemic risk event. You continue debasing your currency until it can't be debased no more. So it's always triggered by some kind of, if you think about the 2008 financial crisis, that was triggered by a tiny little island with a population of 300,000 people, Iceland, when the investment bankers took it over, and that triggered off the subprime. But it's always some.
So I'm just going to jump in quickly to interrupt. I've got some highlights from the press release that the team is sending me. I'm going to read out the highlights that are reading out the whole thing. Fed says it will continue reducing its balance sheet as planned. Says vote in favor of policy was unanimous. The statement, we can pin it above, if you don't mind, Nick, if you can pin it above. Let me pin this so everyone else could go through it. Got another point here. Fed repeats it anticipates that ongoing increase will be appropriate. And that's what Wade was talking about earlier when he came in a bit concerned, the first point. Then another point refers to geopolitics here. Russia's war against Ukraine is contributing to elevated global uncertainty, it says, adding that it is extremely concerned about inflation risks. So these are the statements that people look forward to rather than the decision itself. And I think goes back to the importance of the Ukraine-Russia war in what the Fed does moving forward. Another point here, the Fed reiterates that recent indicators indicate modest growth in spending and output. I'll keep reading more highlights, but these are the key highlights so far.
Yeah, I think a useful thing in discussing the debt bomb, because I think one of your speakers, sorry if I got the name wrong, but I think one of your speakers earlier was, talking about we're all traders. Was that you, Wahid? Yeah, I'm not a trader. I prepare for 3 outcomes, and I dollar cost average into each one, and it means that I don't need to predict any of this stuff or care about any of this stuff. And one is, dollar cost averaging into the dollar being the existing empire. At some page, I think in my lifetime that will change, which is where you have a gold position.
So just
and the third is where all the returns are made, which is Bitcoin and crypto.
I've got here Rick Santelli predicts no rate increase in March. So I just want to read that out to you as well. And we'll be reading more predictions here as we get them, but that's just Rick's position at the moment. So we'll see. I'd love to see the anyone listening what you expect to see moving forward. And I know a lot of our panelists will be going through the statement, coming back shortly to give us their thoughts before we get through the Q&As in 22 minutes. Let me see if there's anything else. Nick, anything else on your end? Nick or Jim, anything else on your end? I know you're keeping up with the statement and the news.
Yeah, nothing really new.
Yeah.
There wasn't a lot that was put in the statement itself besides the few bullet points that we've already gone over. I think at 2:30 we'll have a lot more information.
Yeah, in 22 minutes we'll have a lot more. Yeah, Jim, go ahead. I know you've been watching CNBC as well. What's the sentiment like there?
Yeah, I mean, there's a of the experts that they've got on. Rick Santelli's kind of the outlier there on no rate increase in March. I actually agree with him personally. I think that they are feeling the pressure. My personal opinion, quickly before I go to what everyone else is saying, is that this is a slightly higher interest rate. Well, it's decently higher. I mean, it's more than 100 basis points higher than the market, in my opinion, right now. The Fed always follows markets or attempts to make markets. So, but anyway, they were way too low for too long, in my opinion, and they've gotten closer to the market here. They don't have any freaking clue where it actually is at. But that having been said, there is a belief generally amongst the experts that they have on CNBC that there will be a rate increase in March. Santelli, I think, possibly called it right, saying he doesn't think there is. And that's over the fact that I think they're going to figure out that they can't adjust the labor costs any further in what they're doing. But who knows? They may be intransigent and just say we're gonna do it a different way. But I thought that was interesting, his take on that.
Sorry to butt in. Because I'm afraid I've got to run because I've got a babysitting clash. But I just want to point out that it's worth noting that there is a lot of talk that the current disinflationary environment is itself transitory, and I think this hasn't been really raised in this conversation. It's worth noting that much of the disinflationary kind of optimism comes from the fact that commodity prices have fallen, and that was due to in a large part due to very warm weather in Europe and in other parts of the world, which really helped. In Europe, we've also seen the inflation figures come in better than expected today. So I think that needs to be put out there. And if you consider that to be a transitory thing, it's understandable that the Fed is going to be fearful about inflation coming back again at any moment. There's like a cold weather issue, or say things escalate in Europe on the war front. So,
well, Isabella, you're probably
Sorry.
right on target, because listen, we're coming down off of huge inflationary highs on commodities and other stuff in particular. By the way, I just was talking to my former boss, Tim Hillskamp, former congressman. We were just marveling over the fact that soybeans are trading above $15. Like it's freaking crazy. So the core.
I'll just jump in, Jim. I'm just
gonna
quickly jump in, Jim, before going to protocol and Justin. We do have Wahid with some updates. Wahid, you've gone through the press release. What are your thoughts? What are the key points?
Okay, so just first of all, let me give you the market reaction. Okay, the market reaction is higher for longer, yada yada. We discussed that. So now we're pricing in 50 basis points next month, 50% of a move next month, and a 50% move in May. So basically, it's now a toss up between one or two more rate hikes. Okay, but there's a lot less easing in the back end towards the end of the year. So no longer is the market pricing in rate cuts to the degree it was before the FOMC statement. So
And
that's the market.
how are the
Now,
markets?
growth-
Just before we continue with growth, how are the markets exactly reacting? Did we see any much movement yet?
So now the last one is growth is massively outperforming value, which means that people are saying we're closer to the end. And now let me give you the good news. Why is that happening? Is because they basically hinted, and for the first time, that there's dissent within the Fed as to how much longer they need to keep, how much they need to raise. There's this general statement saying it's no longer about the pace, it's about the degree. That is hinting that there are people who are saying, just please pause. Let's take a step back, see what's going on. We can resume tightening in 9 months if we don't get what we need. So that's what's happening right now. That's why the market, at least the tech stocks, the growth stocks, are rallying, because there's enough dissent within the FOMC of people who want them to pause, and that's why we got to turn in the markets.
Okay, that's good to see, and that goes through what one of our panelists, forgot the name, was saying earlier, that they do have 3 new members they had 3 hawkish ones off the board, and then 3 new dovish ones on, and she went through the names.
Yeah, so I heard that comment. So I've followed the Fed governors for a long time. Kashkari was the idiot dove, like too dovish. Esther George was always the adult in the room, always measured. She's actually turned a little bit more dovish lately, saying, listen, don't destroy the market. And Neil Kashkari, who's always wrong, like always wrong, is now incredibly hawkish. So, I appreciate that individual took the history and the track record of these Fed governors. But I can tell you today, many of these guys have switched. But still, the FOMC is clearly split, and there are people who are getting nervous. That is coming loud and clear, and the markets are reacting.
All right, you can interrupt us anytime when there's more updates. Before we go through market update with Nick and go to Protocol for his response, I want to go through the key points again for the audience. Hike of 25 basis points. Fed says it will continue reducing its balance sheet as planned. It says the vote in favor of policy was unanimous. Fed repeats it anticipates the ongoing increases will be appropriate, and then goes to Russia's war against Ukraine is contributing to elevated global uncertainty. Adding that it is extremely concerned about inflation risks. And then the Fed reiterates that recent indicators indicate modest growth in spending and output. Nick, you ready for a market update, or we'll go to Protocol first?
Go to Protocol first, because I'll have something good.
Protocol, Mike is yours. Good to have you back, man.
Hey, how you doing? I mean, I agree with the political speaker. I think the deflationary trend is short term. When you look at geopolitical risks, you have France recently announcing that fighter jets are on the table. You have Russia about to start an offensive. You have Israel, allegedly involved in the drone attacks in Iran. You have China focusing on consumption and demand. And if Iran's energy industry gets affected, they're going to be on the open market competing with everybody else. I think that this is short term. I think the issues are major. I think this distressed debt levels are unsustainable. A lot of it's going to be rolling over the next year or so. This is not including government debt and bonds, et cetera, which already had major issues with funding, and tax revenues are way down. Just look at public commuter services, look at property tax revenues, appeals, et cetera. There are a lot of structural issues that are going to have to be addressed. And this is at the same time we're facing geopolitical issues that have been unforeseen. And if this occurs, you might see other things break out, including, Turkey making a move, et cetera. This is, I long term, I don't have confidence in this. I think short term, if you're a volatility trader and you want to bet the bank, I think you can make a lot of money. But there's not a lot of where's the growth industry that I'm seeing? Tech is dead other than TikTok. Real estate's dead. Manufacturing's having major issues. China's EVs coming out. Where's the growth in the West, right? Where the energy costs are not going to get better. SPR is done. Maybe they'll vote on it and do whatever. Like, where are you seeing sound long-term policy from the West to deal with these issues that are going to justify this? And I think a lot of people are counting on the Fed to bail them out. which may not be the case. I think BlackRock has called it right. We've exited 40 years of stable growth. This is going to be a different time period, but they're in a catch-22. They cannot afford to have the debt burdens this high because it will blow out budgets left and right. And even look at the healthcare sector and their distress levels, which is 20% of the market, which private equity owns the bulk of it. That's seeing major cracks as we speak. So I think that, people are used to this and they don't realize that this is a different paradigm, a different dynamic that people haven't seen, at least the young traders, in some time. And there's no good options. And I'll end with this, people who, have followed me through other accounts, I've been very clear, just like all coins are tied to Bitcoin, the whole crypto market's tied to the equity market. So if you believe that equities are going to see another correction, then it's going to affect, because all the Wall Street players are going to take their money out of crypto to cover their losses and on the street. And that's what happened last time. That's what happens every time. It's not just that all coins are tied to Bitcoin. The whole crypto market is tied to the equities market. And they're much powerful players. There is no Fed backstop, and there is nobody, there isn't the amount of liquidity there if you need it, if things go bad. So I think that these are issues that people really need to consider, because there are major geopolitical risks that aren't even factored. I don't think they factor in earnings, right? When FedEx comes out and is laying off 10% of their directors and officers and saying demand's plummeting, right? I'm seeing layoffs across multiple sectors and not small layoffs to begin with. Where is this demand? Are you looking at the US and Canadian and European consumer? Are you looking at their discretionary income, what they're able to spend at their credit card debt at the higher rates, multi-decade highs in rates? Where's the consumer going to come in? We're counting on China to bail us out, which they may be able to. But some of the data out of there is not great. And especially out of Hong Kong, their real estate market, the package they put in has led to my opinion, a short-term rally in the bond issues. Hasn't solved Evergrande, hasn't solved Hong Kong. There are major issues, and this is going to be the first time, if China is not a global engine of growth, right? You saw the data out of Germany this week. You're going to have the EU, North America, and China basically in a recession for the first time that I can recall. And what's going to lead us out of it? World War III? I don't know. I'll end there.
Yeah. So
Silver,
can I
real
ask
quick, Nick, before Simon, go ahead. Simon, I'll let Simon ask a protocol question, and then I want to get a quick get Wall Street Silver's thoughts, and I'll give you the mic, Nick. So go ahead, Simon.
No, cool. A protocol based upon that. Can you imagine any scenario in which the stock market and the grander economy is suffering and Bitcoin doesn't go down with it? Is there a scenario where the hard money narrative decouples from the market?
Yeah, I think we have players in the market who have real geopolitical goals that short term, they don't care what it does in a quarter or not. I mean, right now, I don't know. When I look at central banks in a lot of countries that are involved with the BRICS, et cetera, moving towards, new trade pacts and new currency unions and stocking up on gold, at the same time it's flowing out of US and London vaults, that concerns me. I think that this isn't just about financial and money interests. We're seeing realpolitik play out, and they're using markets against. I don't know. That's basically. I think anybody who says they do is lying. I agree. I don't think this is going to be overnight, but a beachhead has been established to attack dollar-denominated trade, and you see central banks across the world very, very scared to hold dollars after what was done to Russia. Right? The diesel cap is coming into Europe pretty soon. I mean, they're buying as much as they can, but there are a lot of issues that are going to cause, the inflationary pressure is going to reappear, right? When the head of Walmart goes on and says, yes, there's been layoffs, et cetera, but any money we're saving is going to, increase our workers' salaries because they can't increase cost of living. When you look at, unrest in France and the UK now, 500,000 striking, right? Any money that you think is going to be able to flow back to the consumer or allow for these companies to deal with these new geopolitical issues is going to be going to the workers, because they have to especially keep them at bay when they're sending hundreds of billions to Ukraine while, homelessness is at a record in New York, et cetera, et cetera. Like this is, I know a lot of people who don't see these issues, but if you follow it, you can see the cracks and the fissures, and it's very, very problematic in my eyes.
So I'll go ahead. Could you see? Yeah, Simon, jump in and respond to him, then I'll come in.
Yeah, no, I was going to say, can you see a scenario? What scenario can you imagine where Bitcoin would decouple? Like, if central banks actually decide to buy Bitcoin, that would be What event could you imagine, just based upon what you're saying?
I think it depends if you see multiple nations' currencies defaulting, right? Lebanon just reduced it 90%. I mean, right now, nobody can argue, in my opinion, against Bitcoin for third world and emerging markets if they're seeing the inflationary pressures to be able to use it to hedge so they don't lose their life savings. Not everybody can get precious metals, physical metals in hand. Not everybody can trade. So I think, that may be the pressure needed to have a decoupling, and it's likely, right? Spain's inflation is still came in at a record high. You look at the Philippines, you look at certain Asia. Yeah, we've seen a short-term decrease in inflationary pressures, but I don't think we've seen the end of it. And a lot of big houses and trading houses, etc., agree. So I think if you're looking for what I personally believe is going to lead to it, I think as you see other nations' currencies collapsing or the emergence of a viable alternative, which you're starting to see a beachhead at least be established with the yuan, with what's coming out of Latin America, what Saudi Arabia is saying, etc. I think that those two factors will play a role because nobody wants to see their life savings evaporate before their eyes.
Well, let me jump in here with a little bit of an update. Obviously, the market reaction is one of the things that's most closely watched by everybody here. And what we're seeing so far is the NASDAQ has spiked significantly and actually gone positive for the day. Yet we're not seeing the same reaction from the S&P and the Dow Jones Industrial Average.
Risk assets. So we're seeing risk assets really spike. There you go.
Right. Yeah.
Exactly.
So I don't know. I kind of wanted somebody on our panel to go over that a little bit for the audience. And
Wahid, Wahid would be great for this. Wahid, you still with us? Or
Yeah, go ahead. What's up? Sorry.
Yeah, what's your thoughts on NASDAQ? Nick, give me an update again to Wahid, and I get his thoughts.
Yep, the NASDAQ has spiked pretty significantly and is now positive on the day. S&P and the Dow Jones Industrial Average have not really moved much at all, and they are not even at their intraday highs.
But that's what I said. It's growth is monumentally outperforming value, right? And the reason being is because the markets are saying that there's dissent within the Fed, and so maybe we're discounting 25 basis points March, maybe 25 basis points May, but then we're pretty much done. So that's what the market is saying. So if he comes out very hawkish on the call and says no, well, maybe there's a third or fourth rate hike, I think you'll see that reverse.
And that's the call that starts. That's the call that the call that starts in 6 minutes. That will be streaming live here.
Yeah.
So Prodigal, did I hear you right saying that you said there's no growth in tech? Did I hear that right? Or
no, I said growth is outperforming value. Growth is
sorry, Prodigal. I think he said something about
I think what Prodigal's referring to is there's been a lot of layoffs. I put it in my thread earlier. I did the thread yesterday on this. Just the amount of layoffs, are pretty
U.S.
concerning.
Tech companies. I mean, the only one you see at a tech position of growth is I'm not talking about AI and smaller caps. I'm talking about the big behemoths. Where are you seeing growth? I'm not seeing it.
Got you. What about
so?
China
I'm just quick to be Simon quickly before you go ahead. I'll give you the mic, Simon. Just want to go back to Wahid. One more question, Wahid, before I go to Simon. And I see Piotr with his hand up. With the statements, with the call that we're going to see in 5 minutes, what should we be on the lookout for? What language would be more hawkish, would be more concerning? Because we're all going to listen to it live here. So just for the audience, what should they be on the lookout for?
All right, let me go a little bit. So people are going to want to know 3 tones. They're going to look for 3 tones. Number one, Mr. Powell, have you really acknowledged the second and third derivative deceleration in inflation? Are you really acknowledging the huge turndown in the housing market, even though owner's equivalent rent is still popping up? So, because it's a lagging indicator. They want to know the tone that he acknowledges that there's a very big slowdown and that inflation is well on its course to going down. That's point number one. Point number two, further elaboration on this conflict within the FOMC. A lot of people say, look, what do we lose if we just pause for a bit just to watch what's going on and further evaluate 9 months from now? That's the whole thing about the dot plots. How many people are really scattered much higher in rates and who's there to want to pause? How big is that debate? Because if there's a very, very big debate, then we're getting closer to pausing. And then the third thing is, financial conditions. Everyone knows that financial conditions are easier today than they were when the Fed funds rate was at 1.75%. because the market has rallied. The bond market has hugely rallied. Yields are going down. Yield curve very inverted. So they want to know if he's trying to talk down the market and if he's worried about financial conditions, because if financial conditions are too loose, it makes his job harder. So those three things, in summary, do you acknowledge the slowdown and that you've done a lot of work already? Number two, what's the amount of dissent within the FOMC? And number three, financial conditions.
One thing to add there, Robert Heller, former Fed governor, was saying he sees inflation or the recession outlook, well, the inflation outlook looking a little bit different coming into the next year. And he does note, and I think appropriately, you're watching M2 taper off a little bit. That's not a bad indicator of potential future inflation. That may help it a little bit, but how much will this taper? What are other pressures that are going to be coming on monetary policy moving forward? But anyway, he's calling for a mild recession and going into the next year with inflation, the inflation outlook looking better, in his opinion.
So, Piotr, let's get your take before we.
Oh no! Before that, so I was speaking. Hold on, before I was speaking to myself, I didn't know. So Chief Ernst & Young economist Gregory, he said the following: the first meeting of the year will no doubt be a very interesting one, as it will set the tone for the rest of the year. But rather than a slow waltz, we anticipate an infernal tango as the Fed and markets try to find synchronized rhythms once again. So there's a lot of eyes on today's speech. I would not want to be Powell right now.
Yeah,
Justin, you'll be.
Yeah, look, I
Justin.
mean, my thoughts on this thing, it very much mirrors the federal healthcare rollout against the vaccines. They were always chasing the variants. They were always behind on that. That seems to be sort of the mantra here in the Fed. They just cannot chase this thing fast enough. It's getting so far ahead of them. They make a change, and they're basically 6 months behind. And so I think the terrible thing is, from a political perspective, which I understand, is that there's very little incentive on either side of the aisle to change things, to put pressure on things to go up or down or anything else. Both sides are looking to hit the bottom, right? The Republicans saying, look, we only own one arm of this entire federal government. Biden's in charge. It behooves us to see this thing just bottom out, and hopefully it bottoms out right while the 24 election is picking up. Whereas the Democrats are like, we cannot get to bottom fast enough. Their hope is it bottoms now and that it boosts up so that 24 is not really a raucous time. But the Republicans are basically, gaming for something that's a little longer term, a recession that hasn't even materialized in really significant ways. From my perspective, I'm seeing just the whiplash, right? I mean, if you thought that an 80-inch OLED TV at Costco was cheap now, just wait 6 months. I have no idea what that, it's going to be just this up and down of craziness as far as like sticky inflation versus stuff that's transient. And I don't think people are going to be able to make heads or tails. The numbers are all over the place. And that's what happens when you have this very, very interesting, awful thing. Oh, it looks like they're starting here. Let me pick it up.
Yeah, it should be starting.
Let's go. Kick it off, Justin. All right, let's do this.
Let me see if we can hear this here.
So everyone, please keep your mics muted.
They're just sitting there. Oh, here he goes.
And then
see if you
Powell
let me know if you can hear this.
Good afternoon.
Got it?
And welcome.
Yes, perfect.
My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5% to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed. Demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions. Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts in March.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be. And that's obviously back in December. And the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in. And now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector. And they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening. And for the reasons we thought, it's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex housing. Sorry, the core services ex housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that research would show is sensitive to slack in the economy. And so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet. And I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves. We see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation. And we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right? By inappropriate measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy. And I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria. Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smiley from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech. And I wonder if that view is broadly shared on the committee.
So the committee obviously did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points. And we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may be responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, if you're right, if you take very short-term 3 month say measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. most forecasters and would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around zero, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough. But I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors though that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think it's earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Waller suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence?
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job. And it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about, we had solid job growth. Everyone's from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So again, my forecast and that of my colleagues, as you will see from the SEP, and I mean, there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession. And we have inflation moving down, into the somewhere in the mid 3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast really. Given our outlook, I don't see us cutting rates this year if we get our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Scott.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while. And I think we knew we would take it out at some point. There's never a perfect time, but we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly or post-meeting statement as an ongoing economic risk, as opposed to a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Wanted to go back to another thing that Fed Vice Chair Lael Brainard said recently. She said she doesn't see signs of a wage price spiral. And I'm wondering if you agree with that.
I do. Yeah, I do. I don't see that yet. But the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision making, inflation has become a really salient issue. And once that happens, that's what we can't allow to happen. And so that's why we worry that the longer we're at this and the longer people are talking about inflation all day long, every day, the more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low, with 3.5% unemployment and high wage increases nominally by historical standards. Why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart is consumers and businesses that essentially we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%. And it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down. And it's a very positive thing.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement. So I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple of times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer faster to that drop dead debt ceiling deadline. Could it play an effect as we get closer to that drop dead deadline this summer?
It's very hard to think about all the different possible ramifications, and I think the answer is basically I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Whew. I wrote a whole thread, by the way, pinned above everyone. I've got a whole thread of all the summary, everything we just everything
Good stuff.
Summarized.
Good stuff.
I had it all in a thread. Can you hear me, by the way, Justin?
Yeah, I think I hear you. Can you hear me?
Yeah, I can hear you fine. Yeah, so I just added everything to a thread. I was writing it, not writing it. The team was sending me the information. I was adding it to the thread as we were doing this. So it's a really long thread, probably the longest one I've done. It's a summary of everything. Let me get protocol up. I don't know where Piotr is. Let's see where Wahid is as well. Let's get the crew back up to get their thoughts on this. But the markets, how are the markets reacting, Nick?
Seem to be spiking a lot. I know the NASDAQ is finally green. S&P is green. The Dow was green. Let me see what it is right now.
Bitcoin up 450. I mean,
Bitcoin is up.
It's popping.
Yeah.
I think there's some tentativeness. The Dow was under 300 points, and now it's up by just like 85 or something like that. So it was up higher, and then I think people are just kind of like, what's going on here?
something Jerome Powell said ended up, it happened at right around, let's see here, 2:35. So like 5 minutes in, we just saw a ridiculous spike in all of the indices. So
Dow just turned red again.
Oh, did it? Oh, I still see it as up, but interesting.
Dow just turned red. Okay, Wahid, I was just about to send you an invite, Wahid. I didn't know you're there. I'm like, where the hell is he?
Yeah.
Wahid, what do you think, man?
All right. So
tell us.
Let me just give you the summary of the three narratives that I said. You asked me what's the focus on. The first is, what's he going to say on the economy? Is he going to acknowledge disinflation? Is he going to acknowledge that he's made a lot of progress? The second thing was, how is he going to describe the dissent amongst the committee members? And then the third thing was, what's he going to talk about market conditions, right? And the fact that the market is ripped, et cetera. And so there's been an easing of financial conditions since like the summer. So let me go through 3 points. First, on the economy, oh my gosh, he has mentioned disinflation like, I don't know, maybe 50 times. That is a very big signal. Okay, he is basically saying, guys, we are now acknowledging that we are nosediving in inflation, that a lot of things are lagging, owner's equivalent rent, he even touched upon real estate, etc. And he also said that he is not worried about a wage spiral. So he actually thinks wage spirals are, the wages are tame. He talked about subdued growth, and he even said it is not impossible to think that we're going to get a mid-threes inflation by the end of the year. So that's very, very important, okay? So in terms of, that's really what's spiking the market, is him really harping down that, guys, mission accomplished kind of thing. But hey, let's not ring the bell yet, etc. But kudos to everyone. You're right. We have disinflation. That's single-handedly the biggest driver of the markets right now. On dissent, very weird. He said, wait for the minutes. Wait for the minutes. And he basically are acknowledging, guys, you will see in the minutes that there's many people that want to pause and there are people who don't want to pause and they want to, keep going deliberate. The fact that he did not say, hey, this is unanimous, etc., he basically attenuated to the fact that there's a push-pull within the Fed that people want to slow things down to see what's going on. Then the third thing is on market expectations. That was crazy. He said, there's no tug of war. The market is doing what it's supposed to do. It's just discounting that inflation is going to hit my 2% far faster than we think. And then he gave the big zinger, the biggest zinger he's ever done in the last year, which is, if the market is right, then hell yes, maybe we will cut rates at the end of the year. He has never, ever said that. Every single narrative coming from the Fed was always, higher for longer, etc. Today was the first time he said, hey, we're in the 3.5% to 4% range. Market is saying that maybe we get disinflation even faster and that we're going to get lower inflation. And so if the market is right, then the market will be right. And we will basically acknowledge that the market is right. And then maybe we cut rates. That he has never said before. Hence why tech is going up and growth is outperforming value.
That's pretty
very
bullish.
interesting. Very interesting.
Yeah, I've taken all the points here.
It's pretty sad I've done this for 27 damn years. But anyways.
Yeah, but he said this is the first time that he hints. What was the thing he said? That's the first time he ever acknowledges
that he's acknowledged.
That he acknowledges.
He says, listen,
yes, in this entire cycle, that's the first time he acknowledges it.
He said, listen, we are higher than the market. But don't berate the market, because there were many questions. Well, the market is expecting you to lower rates. Is the market wrong? Is this a push-pull? And then he was like, look, the market is the market. The economists think that we're going to hit 2% faster than we think. And then someone said, well, what if the market is right? Would you consider cutting rates? And he said, sure, if the market is right, we don't think it is. But if the market is right, sure, we'll reevaluate when it comes. That's a very powerful statement. Never said that in the last year.
Yeah, I read the speech and it's clear. I mean, I'm going to leave. I have to leave, Mario. So I'm just going to say my piece. I agree with a lot of what he said. I agree with other stuff, right? Rental prices are going to moderate and calm down. There's more rental units coming on the market in 2023 than in decades. And the supply is going to increase when cities and commercial landlords finally capitulate and repurpose all the empty commercial and office space. But it doesn't solve the single family issue, right? There's no supply, right? Builders aren't building. Wall Street has really entered the single family home ownership, and buying mass developments and volume is just non-existent. There's going to be deflationary pressure with the auto market. We're seeing that. The dealer MSRP markups are done. You're seeing price cuts that occurred from major manufacturers. I think Ford announced, Tesla, and you're going to start seeing incentives come into play, and it's going to affect used cars. International shipping, those costs have been down. A lot of people believe we're starting to see the emergence of a price war between the container shipping companies. So he's right about the structural issues with COVID, and the demand destruction is real, right? He's saying it like he's celebrating it, but the U.S. consumer is dying. You look at household formations at all-time lows, household debts at all-time highs at increased rates, declining the savings rate, household wealth, disposable income, wages rose, 4%, cost of living rose 8%. Like, they're tapped. And this is on top of, if the emergency powers end in May, you're going to have a whole bunch of consumers now have to start paying their student loans on time again, right? I think the things he's discounting that he sort of mentioned and didn't reference is that the Fed can't cut right away until they know inflation is at best. At best, they can do is stay neutral. And that might be at least a couple of quarters before they feel confident enough. So I disagree with the analysis. He's saying we're going to cut right away. I don't see that. I don't think they can. Major studies that have shown once inflation goes over 7%, it's very hard to tame it back down. And if you do it too soon, you basically screw yourself, right? The era of free money is over. Debt financing burdens are going to stay high, especially if they can't cut right away. And what are they going to do to address this? You look at SPACs, you look at IPOs, you look at mergers and acquisitions, they're basically dead. And for the unemployment numbers, I don't believe it, right? Lockdowns broke a certain portion of the population who may never re-enter the workforce. They got a lot of freebies, but these numbers don't count a whole bunch of able-bodied Americans forced out of the labor force because of vaccine mandates. And even if they were allowed to collect unemployment for a year, that's over. So these numbers.
I want you. So protocol. I'm gonna DM you. I want you to join back in a bit because we're gonna pivot to the more the
I'm leaving right now.
discussion.
I'm basically done now.
Well, if you could, but I want you to actually come back. I genuinely mean it this time. Not the way to end you.
I gotta head out for the next couple of hours.
Okay.
I'm on my last points right now. And for the labor costs, I agree. Listen, tech and other stuff, they're bleeding out. H-1Bs might have to leave the country. But if you look at government costs and employees, first responders, healthcare, there's a shortage of workers. Look at their overtime numbers, and they can't even control it. Look at skilled laborers. Even though nobody's building, it's impossible to find trades. Go try to find a mason. Go try to find somebody in HVAC. Go try to find a plumber. They're writing their tickets, and you're going to see increasing strikes. And for demand, that's fine. The U.S. consumer might be hurting, but is he factoring in that there's 5 million more undocumented illegal aliens in the U.S. that are going to be competing for housing and goods, et cetera? And this is at the same time when both the military economy and the green tech economy is ramping up and is highly dependent on rare earth elements and precious metals. And none of this includes escalation of the Sino-Russian alliance and what we're seeing in Iran, if Bibi makes a move, et cetera. So I don't think you're going to see cuts this year. At best, minimal raises and a pause until things simmer down.
So, I'll go protocol. Appreciate it, man. Protocol. Jim and Nick, what I want Jim to do is give us an update. What are you hearing on CNBC and Bloomberg? And then we'll go to Nick for a market update. Then I want to go back to Wizard and Wahid. Thanks a lot, Protocol. Go to Wizard and Wahid. Just on their thoughts, Wizard, on your thoughts on what we just heard today, because the markets are looking good. Jim, do you want to give us a quick update what you're seeing on the news, and then we'll go to Nick for a market update.
Yeah, CNBC came out of it immediately to Gary Cohn. For those, I think everyone here knows, but for those who don't, former COO of Goldman Sachs and former Trump administration economic policy advisors. He was really shocked, actually, a little bit at the dovish talk that he saw Jerome Powell give.
Good to hear.
Yeah. Although he thought, and he said that because he thought that Powell had many reasons to be hawkish. So he was a little bit surprised about that. He kind of agreed with him on the employment numbers in that regard, or at least noted what Powell said about the unemployment numbers. But his summation, though, was that there's one more meeting in March, then they are going to be off for a month. And he's predicting they'll have a 25 basis points increase in March. And then, as he said, Powell said, I've got 2 more months of unemployment numbers to look at, and then we'll see where they go from there. That was kind of his summation of it.
Thanks a lot, man. We'll go to Nick for a quick market update before we go to Wizard.
Okay, yeah. So it looks like we are continuing to rise here. The Nasdaq is now up 2%, so 2 points up. The Dow is a little bit more stagnant. We're only up a tenth of a point. And then the S&P 500, we're looking at a 1% increase. And the interesting part about this, and I'd like to have a little conversation about this after we go to Wizard, but as to what people heard, what investors heard during Jerome Powell's presser that would have caused practically an instant spike to send all the indices into the green.
Yeah, I think Wahid covered that well. But Wizard, I don't know if you heard what Wahid covered. I'd love your objective thoughts on what you just heard. Should we start popping the champagne bottles? Because it's looking pretty good.
Yeah, no, I did not hear what Wahid said. I just literally jumped on because you had DM'd me.
Perfect. That's even better because I'd like to get your objective thoughts.
Yeah, always. I always give objective thoughts. Listen, I think it was one of the most non-hawkish speeches and conferences he's done in a long time. I mean, it's a big difference. I study these speeches very aggressively because it's very important for my portfolio. So his worst speech, the most hawkish, was Jackson Hole a few months back. When we had that big summer bear market rally, and then he came at Jackson Hole and just brought the wood chipper out, and we fucking tanked like really hard for the next few months. But this was a complete change. A lot of points that he emphasized. His initial speech when he started was kind of hawkish. He definitely said there's a lot of work to be done. We're looking to raise more, et cetera, et cetera. But two things, they always had the optionality to go 50 basis points. They had the optionality to give guidance for like 2 months for it to be 50 basis points. They accepted the fact that wage inflation is showing some signs of cooling down. But obviously, there's a lot of work to be done. They acknowledge that goods inflation is trending lower, but there's work to be done. These are not things that he ever accepted before. He said, we're nowhere close to seeing any trend. We're nowhere close to seeing any form of drop. So obviously, market reacted, right? I mean, this is literally, when I jumped off earlier, when I gave the scenarios, I said, listen, there's an 8% probability that he comes in not hawkish. And if it does, you're going to see a 3 to 5% rally in NASDAQ right away. And that's kind of what we're seeing. Because markets were literally just reacting to his words. Even the Q&A, every Q&A you go look at was extremely hawkish over the last, couple months. This is the first one where he kept acknowledging everything from, the fact that, they've been hiking a lot, that they did fast-paced hikes earlier, and now they're actually discussing on the path ahead. That was something very interesting. He said, the committee is discussing the path ahead when people asking about cutting. So the fact that they're even thinking about that when even in December, his speech, he said they're not thinking about cutting at all. The fact that they're even thinking about a path ahead when they're asked about cutting is definitely, something great to see. I think the fact is that, he acknowledges that, listen, they kept saying that the soft landing was a potential this whole time, and the market just kept fading it. And then now the market's starting to put it as a baseline, and Powell's like, listen, people keep saying a soft landing is not possible, but we think it is. There's a great research article that the Fed of Chicago put out, I think, a week or two ago, summarized in my newsletter too. It talks about how they can actually achieve a soft landing, and it's by the Fed. It's a really great article. You guys should take a look at it. But yeah, I'm very bullish. I wish I was longer into it, but just, I definitely got long during the speech. I think the main event is still Friday. I think the market's going to see that as well. So if Friday comes out good, we're going to see the entire month of just green candles for sure.
I already jumped ahead. I already made a tweet saying, should we pop the champagne? Just for the audience, what we've done is two things right now pinned above. If you go at the top, it's pinned above. I'm going to retweet as well, one of them. So the first thing that's pinned that I've just retweeted is a newsletter. So we summarize all this in a newsletter that's coming out soon, recaps of spaces. But the second thing that's also pinned that you got to check out is a summary of the entire speech and the points made and how the markets are reacting. It's all in the thread. We do have new panelists. We've got David on the panel. We have the economic long wave as well. I think it's the first time on the panel, so we'll go to them shortly, and Joaz as well here. Wahid, want to go back to you before we go for a quick update from Jim and Nick, responses from different economists and anyone else watching this. What's your, should we pop the champagne, man? Are you Are you less stressed than you were last time we met? Are you happier? Should I be with you in Cyprus celebrating?
All right. Well, look, okay. So where are we today? We are where I want. Well, I was hoping the Fed would start getting to. Okay. In terms of popping the champagne, do I think the S&P is going to go to 4,800? No, I don't. I don't think it's going to go to 4,400 either. I think we're going to rest here for a while. So I think we're popping the champagne in a sense that we finally see the light at the end of the tunnel. We know that rates are at best 20, 50 basis points away from being paused. I love that the Fed is no longer fighting the tape, no longer fighting the bond market, and is acknowledging that, hey, maybe the bond market is right, and maybe disinflation is even faster than we think. And so if they're right and we're wrong, then we will absolutely embrace the bond market and look to start taming rates and actually even cutting. That is, again, very new and hasn't been said in over a year. So I like that. But let's talk about earnings, right? S&P earnings at best probably 200, 210 this year. Margins are getting pressured because with disinflation, what happens with company earnings is that they get the benefit of last year's inflation on the revenue side, but now you still have lingering wage growth, and now with disinflation, you get pricing hits. And so I actually think margins could be pressured. So what you end up with is, okay, an S&P 500 here at 4,100, 4,200, but on earnings that are at best 200, 210. So now we're talking about being as expensive as we were, in the last peak. So so I wouldn't pop the champagne markets wise. I think the time to have been very bullish was we were on our deathbeds last summer. So today I'd be a little bit more picky,
you think a lot of
and a little bit more
so you
patient.
think a lot of what we, before I ask the question, audience members, I want to see if you're bullish or not. Bottom right corner in the purple, I want to see who are you guys more bullish or more bearish? Wade, you're saying that the market's already priced in a lot of what happened today?
I always say we're 6 to 9 months ahead, right? Market always prices 6 to 9 months ahead. So I feel like a lot of the rallying that's happened in the last 6 to 7 months is reflective of where we are today, right?
But did they really factor in that much dovishness from the Fed?
Markets did. The bond markets always
No, they didn't.
Absolutely.
The bond market did not price in.
Sure. Look at the 10-year to the 30-year. How could you not possibly say
No,
that?
the bond
We had the
market
most
did not
inverted
price in
yield curve ever.
dovishness on the Fed meeting today. They've been pricing in inflation lowering down as data came out over the last 3 months or 4 months. Powell said that they're going to start bringing down like in November, like October, right? Like they're not going to do 75 basis points. They bring it to 50 to 25. Market didn't price in today's dovishness. That's why the market's rallying. If it priced in, the market would not be rallying, right? I mean, that's
Right.
what it is.
But on the margin, you're right on the margin. The point I'm trying to make is that the market has always been ahead of the Fed. Always. It's always ahead of the Fed. Let's go back to the first 5 minutes of this Spaces, right? We give way too many kudos to the Fed, and we keep worrying about the Fed, and oh my God, and they're going to destroy the rally, etc. They always ultimately capitulate to what the bond market is pricing, because the bond market is usually, actually, I would say, mostly right, and these guys are always behind the curve.
Yeah, I agree. I agree with that 100%. I think the bond market was pricing in, but not the stock market.
Yeah, go ahead. David, go ahead.
One thing I will say about the bond market, and what's really interesting, is most participants are price insensitive. If we aggregate insurance funds and pension funds, in reality, they just buy these treasuries in accordance to, let's say, redemptions of clients, especially insurance funds. They'll claim them in accordance to mortality rates. And so the influx of clients will be then in an appropriations to, let's say, 5-year, 10-year, 15 years of mortality. Same thing for a pension structure. And if we're looking at the majority of, let's say, participants, it's actually the Federal Reserve's balance sheet. It's the government of the United States and the pension structures that have price insensitivity and that would prefer a higher yield for lower price bonds.
So, David, the question, the golden question: pop the champagnes or too early? Are we going to start seeing the beginning of a bull market, or?
So I'm on Faith Tribe's rhetoric here. I think it's too early to pop the champagnes. I think that we are going through an earnings compression. The cost of capital has certainly restricted a lot of companies to do maneuverings, especially accounting maneuverings, such as like Tesla. They have eligible interest rate hedge providers, and in which they would take their short-term debt or long-term debt and continuously roll them around with different credit providers, Deutsche Bank, Citigroup, and other formal providers. And many companies had the same practice. In these environments, we're no longer able to do so. One of the big things that I find really interesting throughout the whole discussion, we had no notion of the actual QT and or the actual, quantitative tightening that the economy is going to go through. The last question was actually the debt ceiling in relation to quantitative tightening. And he was then talking about the Treasury General account, how its reverse repos will shrink and will grow in accordance to liquidity needs. And this is what I find really interesting, because throughout the whole discussion, we still haven't seen the true effects of quantitative tightening, and it's actually been quite damped. On my tweet thread, you'll see that I've posted an illustration and a visual of how the actual QT has been felt throughout the economy, and in reality, it's really not in a majority of the balance sheet. And 90% of the balance sheet is held within note bonds, and we haven't seen a majority decrease within these note bonds. And once we see these formal liquidity decreases, there's actually going to be formal impacts within the balance sheets of these pension funds. And I'm going to finish it on this. If we aggregate the total top 21 nations of, let's say, pension structures, it goes up to $17 trillion in US nominal value. And when we look at the majority of participation, it's actually within the treasury structures of the United States.
So I've got a few updates coming in. Jim and Nick, I'll give you the mics in a bit, because I know, Jim, you've got a few updates as well. So I'll give you the mics in a bit to update the audience on this and the reactions of the markets. I do want to ask a question to Wahid, and I know we have Long Wave, Joseph, waiting for us as well. So I'll go to Joseph in a bit. But Wahid, quick question for you. What could change all this? What could lead to the Fed becoming more hawkish? Anything beyond geopolitics?
Sorry, you mean what could make them more hawkish or more dovish?
Hawkish. What could change all this? What could change
So
whatever we heard today?
I'll tell you what could change all this. So ironically, this is why I can't stand them, because they're always sort of, again, behind the curve. But if financial conditions keep easing and we get to 4,400 on the S&P and people start spending again, so inflation starts to tick up again, and then companies start to panic and stop laying off people because, holy shit, they went through hell in a basket in terms of hiring people right after COVID because labor was in such short supply, then what you'll have is, Mester and Lyle Brainerd and all these folks come on and start putting a narrative that we're not done, we're not done, we're not done. They will dial this back because basically, financial conditions, like look what's happening now with financial conditions today. They're really easing. The greed and fear indicator is slowly creeping up to extreme greed. And so what's happening is, they're losing control of the narrative, right? And so that would make them more hawkish. The comment about quantitative tightening is so good, the previous speaker just said, because quantitative tightening is happening in the background. And look, we are 4 months away from debt ceiling. And so, 4 or 5 months away. So when you're tightening on quantitative tightening, you have less bonds that you're buying, or there's less aggregate demand for all the supply that's coming through. I think that's still playing in the background. You've got the whole issues with what I really think, and you should do a spaces on this because no one's really talking much about it, Mario. But Putin is amassing a huge amount of troops. I know some people are writing about it.
It is on the agenda. I did a tweet about it as well. This is a very serious matter.
Right.
Yes.
It's a very serious matter. And look where the DAX is trading. It's like 10% away from all-time highs. It's like a joke. So I was very bullish.
So it's back to back to geopolitics. Geopolitics is still your biggest concern.
It's quantitative tightening, it's geopolitics, it's financial conditions, and the stock market ripping so hard that the Fed narrative will probably want to dial things back. They'll go on the circuit and start being a little bit more hawkish, etc. Because if inflation starts to pick up again, because financial conditions have eased so much, then they're back to square one.
So I've just got a couple of quotes before going to Jim. I've got here Ryan Detrick, Chief Market Strategist at the Carson Group. I'll read out what he said. The Fed threw no curveballs, as they did what was widely expected. The doors cracking open to end rate hikes, but they still have a chance for one more rate hike at the next meeting. The economy is still growing, which is comforting, as the Fed is not worried of an impending recession. Investors should be happy that we will likely have a Fed that is going to end hikes fairly soon as the inflation data continues to show major improvements, which is exactly what the Fed needs to take their foot off the pedal. Yesterday's employment cost index was an improvement, and Powell said he needed to see employment costs improve before he stops hiking rates. How close are we now with ending the rate hike cycle when it's clear employment costs are slowing? So that was Ryan Detrick. I've got one more before going to Jim. Ellen Hazen, Chief Marketing Strategist at the Putman Investment Management. We're going to read out what they said. What Ellen said. The key thing the Fed is focused on is wages, and we are seeing wage inflation continue to ameliorate. If you look at both hourly earnings and the employment cost index, which just came out, wages are beginning to soften, but they are not softening enough to get inflation down to that 2% target. They are specifically looking at the non-housing services portion of the PCE, and as long as wages are still growing at 5-ish%, you are not going to see the Fed back off. Jim, anything on your end before we go to Wizard and Long Wave?
Yeah, real quick. Gary Cohn brought up another interesting dynamic in all of this, and that is the negotiations on the debt ceiling. My personal opinion is the fights over the debt ceiling I don't think are harmful, except in short term as they might hit markets and people get all iffy about it. But so he's bringing up the point, we don't need that right now. It can cause a lot of problems. Pay the bills right now. Yeah, they'll get paid eventually, but that's not the way to do this. And so that kind of discussion's coming in here. That's going to have some effect on markets. I think it's an important, and from my perspective, an important debate to have, because I think it feeds this whole system of what we're seeing play out that the Fed's dealing with. But also, he also made a point that on the employment end of things, that people just might, there could be another economic downturn coming later in the year, right at the time that people are deciding they can get back into the markets as wage inflation keeps at least hovering or going above. And that his speculation, which I think is an interesting one, that may just give Powell and the Fed their excuse to back off as those two things converge, which in my opinion is goes counter to the way economic things are really playing out. But that is actually going to be a very significant factor into where rates go through the year. He also reconfirmed Powell's view that rate increases are still working themselves into the system, and we really don't know what's going on yet. And one of the things when I look back at this, because David brought up about quantitative tightening. I mean, there are some factors that they're not being discussed right now from the FOMC meeting, like quantitative tightening and some other things that really they're unknowns. We don't know how and in what way they're going to play out. And I think we've got a lot of cloudiness looking forward. I don't think there's a real clear path. I think the discussion so far has been pretty accurate about how it'll probably play out, but that assumes that these more cloudy factors don't go haywire. And I think employment and the way quantitative tightening is taking place, whether they keep doing it or pull back from it or whatever, are still factors that we just don't know how it's going to play out yet.
Cool. Before I go to Wizard, I've got here Chris Anstey. Jeff Rosenberg, a senior portfolio manager at BlackRock, says on Bloomberg TV that there's, quote, a real disconnect. Well, he's going to like this, between what the Fed statement and Powell said on the one hand and what markets heard on the other. Rosenberg suggests that Powell flubbed the question about whether the easing in financial conditions hurts the Fed. Quote, it absolutely matters, in Rosenberg's view. Just want to read it. What do you think of this, Wahid? I've got more here. If Powell went in today's press conference determined to deliver a hawkish message of the Fed not being near calling victory, it's not clear that he accomplished that. What investors seem focused on is what he said. For the first time, the disinflation process has begun. The question is whether the Fed speaker will now start coming out with harder-hitting messages about the danger of stock and bond rallies, basically undoing their tightening. Wahid, Wizard.
You know, I'm gonna answer this. I'm gonna go freaking crazy right now. I'm gonna answer this slightly differently. You know, who the fuck does this guy think he is? This guy, this Powell, he thinks he is just a mannequin. Just control every fucking thing in the markets and the economy has to be under his fingertips. Unbelievably arrogant. How the fuck did we give these guys this much power? I have no idea. So the point that Rosenberg is making is, oh, okay, well, the market is rallying and he wants to micromanage that and he doesn't want inflation expectations to go back up again because financial conditions are easing, etc. Let's just take a step back. Audience, how ridiculous is this? That a bunch of unelected bureaucrats sit there and want to control every single damn narrative. And when they see the markets rip because they, had a certain conference call and a certain tone, then they want to dial it back, et cetera, et cetera. Like, this is not capitalism. This is not normal. The fact that they want to micromanage every bloody tick. Anyways, I'm done with my rampage here. The reality is, okay, Rosenberg is saying they don't want to see markets rally this hard. They don't want to see financial conditions ease this much. They want just enough dovish sentiment, but not for us to get carried away. That's what Rosenberg is saying. The whole thing is damn ridiculous. Sorry, I didn't answer your question, did I, Mario?
No, mate, just very, very emotional. But I think you touched
No,
on
it's
it.
just it's ridiculous. It's like they manage the bloody world.
The audience. I'm looking at the comments. The audience seems to agree with you. Every time you start ranting about the Fed, they all go crazy in the comments.
Just watch what that is. They are micromanaging tick for tick. How pathetic is this? How the hell do we have a normal world economy when a bunch of unelected bureaucrats want to manage us tick for tick? Like, who the hell gave them that authority? How the hell did we get into this position? It's mind-boggling.
Wizard?
Yeah, I mean, man, honestly, it seems like a lot of people are not long or short on this panel. I mean, all I'm hearing is just doom and gloom, bearish sentiment. Listen, I mean, there was a time to be a bear.
Not me, man. Wizard. I'm with you, man.
Okay,
I'm bullish.
mean,
I think that we've
we're here
capitulated,
to
man.
make, I don't know, maybe people have other, listen, all I care is about making money. Literally, I really don't care about anything else. Doesn't matter who's in charge. I'll analyze Fed, or if it's not the Fed, if it's a king, I don't care. I'm just in it to make money. And all these people on CNBC I'm watching, first of all, you always fade CNBC. I mean, most of these plebs know nothing. And the ones who do, they talk their book. Obviously, everybody knows, like, if you look at positions, BlackRock's got no long position. Like, so the way BlackRock is, it's like an index. So you need to be long to the index. Like, you need to have a higher duration than the index. So all these guys are basically short the index. So they're going to get no bonus this year. So they're all like talking doom and gloom. And it's just nonsense. The time to be bearish was from November of the 2020 to June to like July of the summer. Like, that's when you have to be bearish. That's when all these guys were bullish. Like, if you look at 2022 outlook in January that BlackRock put out, they were calling for close to 5,000 in S&P. You look at the average of all the banks, all the CNBC pundits were calling for 4,500 to 5,000 to 5,500. I think Bank of America, Goldman Sachs, one of them had like 5,500. I mean, that's ridiculous, right? Right now, this is all good. I mean, we literally were just down so bad. If you're in crypto, you were down even worse. It was the worst year. If you're a bond trader, I mean, like that's like my bread and butter. It was the worst year for bonds, long bond portfolios in like some 20, 30 years. I don't even know. I think like ever. So the time to be bearish and time to get angry and time to was like, like 7-8 months ago. Now is the time to be bullish. Now you buy the dip and you sell the rip, right? What I'm hearing is constantly people who are like coping because they didn't buy.
No, completely disagree. The time to be bullish was 7 months ago.
People are now getting all like they're like, oh no, we're gonna dip, we're gonna capitulate more because bear posting gets you massive engagement. Right now is the time to be bullish. Like, you need to fade the retail, you need to fade the public. Like,
but Wizard, Wahid is saying that the time to be bullish was 7 months ago. What do you think?
Well, I mean, markets
it's already been
tanked
well
a lot
priced in
the last. That doesn't make any sense because we saw new lows like 3 months ago. Crypto saw like 15K on Bitcoin like literally 2 months ago. So I don't understand how that makes any sense. But because we got way lower, I think that.
No, we're just talking about the August. We had a huge Twitter Spaces back then. We talked about markets. Everyone was doom and gloom. It was the August lows that we talked
Yeah,
about.
so
Anyways, but
that's what I'm saying. I
August.
mean, there was a bear
One
market
thing I will
rally
say though, for
like from June to July, because I mean that was a true bear market rally because there was no reason for it. We were still at 9.1% inflation. Market was constantly trending. Inflation was not showing any trend of moving lower. Powell came out at Jackson Hole and brought the wood chipper and brought that bear market rally back down. This is the first time. I mean, even if you're, listen, I'm not a big technicals guy, but even if you look at the year-long technical trend line that's been like held, today is the first day that with volume it broke that on S&P and Nasdaq. So every little thing is great. I mean, I'm not saying that we're just going to, it's going to be one shot all the way up. Like I said earlier, I think the Friday number is way more important than what happened today with Powell. If that comes in, then it's 100%. It's complete takeoff mode. We're going to hit like easily 4,200.
Okay, so breaking news, Mario. Sorry, I got to interrupt.
Yeah, tell us.
Okay, so I just got a DM now saying that I need help from the audience. Did the mouthpiece Wall Street Journal Nick put out a statement that we misread the dovishness? Anyone see that?
Wait, really? He put that out?
I'll look into it.
And a bunch of guys.
Who said that? Hold on. Who said that? Who said that? Wahid?
Did Nick from Wall Street Journal, the mouthpiece guy? I don't see anything, but that's what I just got DM.
So you're talking about the Fed whisperer?
Yeah.
The Fed whisperer said we misread the
market is fading
dovishness.
right now because the Fed is trying to indicate to the market that we misunderstood his conference call.
That would make sense because based on the number, well, the Dow in particular is now, it went from being up about 1.3%, and it's now in the red marginally.
It's in the red.
I cannot understand. They don't realize how damaging this is. I don't want them to rip or bet. This micromanagement. Anyway, I'll shut up.
So hold on. So can someone?
Let me jump in there real quick because Waleed was right when he said on that basis where the market is right now, the fact that it's leveled back down to where it was, I think makes Waleed's point that everything was priced in 8-9 months ago, because all that was early on was a reaction to the current news and then people trading.
But
off
Wahid,
of it.
but Jim,
Wahid
just mentioned something important. I need to know if this is true. I don't know what the source is.
I don't see it anywhere. I don't see it.
I can't find it yet.
I see. Wizard just freaked out and jumped off, unless he dropped out. Because I know when Wizard drops off, means he's gonna. Yeah, he just jumps off because he's gonna act on this. He's going to sell his positions. Wizard just jumped off to sell his positions live on stage. Okay, so I need to know if this is true. Let me check with my team if this is true. So Romy, if you're listening, I need to know if what he just said, did the Fed whisperer say we misread?
I don't
Wizard
think
is coming
so,
back up.
because I have a site where they put that live. I don't see it. So I do not think he did.
Wizard, did you see anything about the Fed whisperer saying that we misread the dovishness of the he's just connecting. And David, feel free to jump in on this one. Does anyone know about the Fed whisperer's comments, or is that not confirmed yet?
So I have no confirmations over the Fed whisper. One thing
I
will
don't
say,
think it's I don't think, but it is BlackRock. It is some of these other commentators. Okay, that I heard. But
yeah, that happens. That happens every month. Just so you guys know, not from the whisperer, but from the media always reports that we misread the dovishness.
Yeah, and for the average,
I'm looking at Nick's latest report on this right now, just based on his Twitter. I would imagine this would be something that he would tweet. And the latest report that he has basically just hits on what we've talked about so far. There's no bombshells or anything in there. I don't know.
But did he hint that we misinterpreted it?
There's nothing like that. I just went
that.
through. That's just nonsense.
Nope.
His last article was 38 minutes ago. After the conference, yeah, it's just everything that happened at the conference. There's no bombshell shit. Probably just somebody who's short DMing you on things.
Yeah. All right. Oh, that's good. So just going to go to David. David, you were speaking. But what he does, by the way, if anyone, sorry, David, if anyone gets updates on this one, if it actually turns out to be true, just definitely interrupt and mention it and mention the source. But go ahead, David.
So just 2 points. One, when we go before the last three questions that Powell was asked, in that sense, he was asked about the participants and how they were reflecting lower economic conditions, and he then restated that it's important that markets reflect major implementations that the Fed has put in, and that they need to keep rates at a higher rate. And essentially, he had mentioned that they don't see the actual cutting in this year. One thing I will say to Wizard's ideas of this bullish thing, if you were a sophisticated trader, and I'm speaking on a conservative level here because we have a significant amount of people here. If you're a sophisticated trader, by all means, you can maneuver your capital. But in reality, it's better for, let's say, the majority of retail participants to think of preservation of wealth and credit compression, seeing that most participants don't realize that, or let's say a budget for 200 or 300 basis points increase in their actual mortgage payments, going from $1,200 to $2,400 is a huge compression on that level. And I think that it's better to think about preservation of wealth in these types of environments until we have a formal idea of a pivot and or conclusive rate hikes and inflationary pressures and economic conditions that turn around less slumpish in that sense.
So, David, we've seen basically the Fed signal the fact that they're not going to. I know they're facing a lot of outside political pressure, and they've sort of signaled that they're going to continue with these 25 basis point rate hikes. Has the market already factored that in, would you say?
So if we look at Fed funds futures, and I have to review it, but from the last time I saw it back in May, they were perceiving a potential pivot and or a reduction in rate hikes. And I think that what's fundamental is this idea that potentially Powell is trying to break the Greenspan put phase that we've been initiating since the 2000s, and the Fed and how it's participated within the market. And especially once we've finalized the QE that we felt after 2008, essentially its new roles within the market and its consolidations towards volatility and potential standardizations of asset classes around participation is quite significant. And I think that when we're looking at the global aspect, yes, we have to understand why Powell was potentially pushing that the monetary policy has no effects to budget increases and or the debt ceiling, and that he was suggesting that there's precedence for fiscal and or congressional movements to increase the deficit, i.e., if we're going to go through a QT type phase, there has to be an impartial buyer for this actual QT and or the release of the actual quantitative tightening in bills, treasuries, note bonds, and other forms of, let's say, agency debts that the Treasury Federal Reserve balance sheet is going to reduce. And that would imply the government as well, and because they are a significant buyer of, let's say, federal treasuries. And so in that sense, it's going to be a very interesting dynamic.
So I do want to ask you that. We've seen statements that have come from Republicans in the Senate, especially, in particular, Rick Scott, he put out a statement and sent a letter to Jerome Powell and was really hitting him on the Fed's balance sheet. And I'd like to hear if you could explain to the audience a little bit about reducing the Fed's balance sheet, how that's done, and what sort of effect that would have on the markets.
So essentially, when we're going into it's basically done because the majority of, let's say, treasury bills that are received, 30% of the buyers are actual governments and municipal governments and other types of banks, right? And when we're looking at repos and like reverse repo rates, essentially these are going to be the impartial buyers of the releases of the QT. And when we're looking at these balance sheets, they need to be able to uphold the actual increased liquidity and or increased asset that is going to be liquidated by the balance sheets. And I think that this is something that's going to be a interesting dynamic. But one thing I will mention is I saw that Professor Plume was in the room, and he does have a fairly great analytical perspective over quantitative tightening. I did see that he left. So essentially, I'm going to retract that statement. Sorry about that.
Okay, so yeah, we'll go to Joseph real quick. I'd love to have your take on this. If you have any sentiments on what the Fed actually just released, the 25 basis point increase.
Yeah, before on to Joseph, by the way, Romy's going to send you through now the note by Nick and what it could be. So she's going to DM it to you now on WhatsApp. Yeah, Joseph, go ahead.
Yeah, hi. Thanks. Somebody invited me, and I might be in the wrong room. But what I'm adding to this insight is I'm looking at the bond market, and I still see it extremely accommodative, the long end. And so I'm wondering here, who has this right? I'm not trying to be bullish or bearish. Is the bond market expecting a massive collapse in the economy? Because I've never seen yields since I've been in the investment business this far apart. I mean, what's the long bond in the U.S.? 3.6, and inflation still running 6.5. So who has this wrong? And the leading indicators, all four that I follow, are telegraphing, we're headed into recession. Equities confirmed that. Now, is it a soft landing or is it worse? I guess we'll find out in the second half. That's all I want to add is the bond markets. You know, somebody has it wrong, and is that they haven't panicked yet, or they're concerned about the geopolitical risk of the evolving war in Ukraine. That's really what's on my radar more than the short-term rates.
David, I'll let you answer this, David. Then I want to go to you and Wizard to get your thoughts. Is your position more bullish or bearish, David, after listening to all this? So answer Joseph's question, and then give us your position on things. I want to go to Wizard then afterwards, and I'll ask Wizard what will make him more bearish. That will be next right after you, David. Go ahead, David.
I'm going to answer your question immediately. I think we're in a time of preservation of capital. That's the most important thing. Understanding your balance sheet, understanding the credit compression that you're going to see. And then from there, if you're specifically retailer, and I would also agree on most businesses, because if business compression is going to continue, then the actual availability for capital is going to be restricted. The cost of capital is going to be higher. And so this needs to be overviewed before any formal type of developments occurs, because significant changes are happening within the economy. Go ahead, Nick.
I know. Before you jump in, Mario, I just want to remind everybody: put your questions for the panelists down there in the bottom right-hand corner, and we'll get to them shortly. And also sign up for the newsletter at the top. We'll go over everything. We'll break down the Fed report. We'll break down, the answers from our panelists, and
there's also along with the newsletter, there's also a summary of everything that was mentioned by Powell in the meeting, as well as market reactions. It was all covered live. The thread is above. It's a really long, not a long thread, but everything that was mentioned is there. Wizard, I want to ask you a question before going to Joa. Joa, make sure your mic is good.
So Mario, I've got some
answer really quick.
Go ahead, Wahid.
All right.
Yeah, go ahead, Wahid.
So thank you for helping dissect. So Nick, Fed Whisperer, basically the tweets that he put out, the comments that he put out, I don't think there's anything new. They were actually dated, meaning they weren't, they weren't like 5-10 minutes ago. But basically, they are being excused for why the market sort of corrected in the last 10-20 minutes. And that's that he was trying to say, look, we cannot declare victory, just taking snapshots of what Powell said in the conference call and just emphasizing those. And they're just dampening, right? It's like, don't declare victory. We're not there yet. We're still going to raise rates twice versus, the markets previously, discounting one more rate hike. So basically, he took the three statements that were a little bit dampened and emphasized those. So that's what market commentators are saying is the reason why there was a correction. But I don't think he put that out 10, 15 minutes ago. I think he just reiterated it after the conference call.
All right, cool. Thanks for the clarification. Wizard, I'm just looking at the markets. I'm looking at crypto specifically right now. I was looking at equities earlier, and it's looking good. What would change your mind? Because you did hint that the worst is over. Excluding geopolitical events, anything else that would change your mind on things, Wizard, and get you more bearish again?
Yeah, wage inflation or goods inflation moving up. So if on Friday the number, if you see unemployment drop again, and if wage inflation goes up to shocks up to 5% then I'm gonna have to rethink my positions. But for now, yeah, I'm as bullish as I can be, but I'm not fully matched long. I'm waiting for Friday still, but I'm like I said, before the conference, I'm pretty long. So yeah, and I'm holding. So
cool, man. I'll go to Joa. Joa, you're generally more cautious. Then I'll go back to David. You're generally more cautious, man. You're the conservative guy. Are you still cautious, or are you getting a bit more bullish? I'd love to know why.
Yeah, just checking my micro quick.
It's good. Just get it closer to your mouth because it's a bit echoey. So I don't know if you're talking from your toilet today as usual, but if you can get it a bit closer to your mic, it'll be great.
All right. Yeah, basically, I think I typically look at macro events. I don't look so much at the numbers. I trust all these guys to look at the numbers, look at their information to help me make decisions. But I look at things that are going on around it that typically people don't look at. So back in the 90s, some of the people here might remember we had a small recession in 91, right? And everyone thought it was the end and it was going to be hell for years to come, and it lasted 8 months. I think we're heading towards the same thing. And right now, Jerome Powell looks like a genius because it looks like he's having a soft landing. And I really don't think he's a genius. So what are the other factors that are making this be a soft landing? And to me, it's the fact that a lot of people had savings. And although transportation costs went up, people are saving a lot more money on transportation than they ever did before. So they're looking at numbers that don't really affect it. Although savings came down, that's also looking at investments, but it came down in the past few months. What I see is probably the same thing that helped 91, where email came to be, the internet came to be, people became more efficient, and the recession turned around really quickly. By the beginning of 2024, two things are going to happen that I'm not really worried about what happens now. I just don't want the Fed to fuck it up until then, basically. We're going to have self-driving cars, right? And self-driving cars will reduce the person's cost per mile from 64 cents to 4 cents. Like it will not make.
So I want to keep digging into the jar, the technological improvements and improvements with productivity. So hold that thought. I don't usually interrupt a lot. But I know you well, so we're chill. Hold that thought because I know Ran. It's really late for Ran. I convinced him to jump on. Ran, you did a great space earlier on this, man. We're good friends, and I always like to listen to your thoughts. I listened to your video as always on YouTube before this space to prep. So would love your take, man. Market's reaction. Your take from a crypto perspective and a macro perspective as well. And as well, what was the sentiment from your panelists when you did the space earlier?
Yeah, so I think, look, we've maintained since the beginning of the year that the cycle has turned. The cycle turned on the charts, but it also turned because, what you realize is that the markets have turned because they said, look, the inflation problem is now behind us. The inflation for the last 6 months is sitting at 0.9%. Remember that Powell's aiming for 2%. Inflation now is at 0.9%. There is going to be an uptick in January, which we're going to hear on the 14th of February, Valentine's night. So if you're out for Valentine's Day, probably not a great day because you're going to see that inflation is going to go up. The Cleveland Fed assumes that it's going up by 0.67, which will bring it up to 1.5 or 1.6 for the 7 months. And so we think that the inflation narrative is now behind us. Powell has acknowledged that. And now there's a new narrative, which is the new narrative is recession. Let's manage a recession. Now, I don't think that recession is as bad as people make it out to be, because I think that as soon as we hit recession, if we hit recession, I think we will hit recession. As soon as we hit the recession, then the Fed has to start loosening and loosening quite aggressively. And so I think today we got exactly what we expected, barring one thing. We got Powell with a 25 basis point rate hike. We thought that he'd be a little bit more hawkish and he would try and talk the markets down. Because the last thing that we can afford is for the markets to continue to run and undo all the good work that Powell has done. So you kind of want to think about it like this. If he would have come out today with a 25 basis point rate hike and he came out dovish, then, which is, probably what happened, then the markets start running. The markets start running, people feel richer. People feel richer, they start to spend more. They spend more, therefore inflation goes up. We thought he'd come out aggressive and hawkish because then he would talk the markets down, people would feel slightly poorer, and he would still manage to keep inflation under control. He tried to be hawkish, but he just couldn't because the journalists were asking him a whole lot of questions and he had to answer them honestly. And it just feels like from now on, we may have one more rate hike, and it's the end of the rate hike cycle, certainly for a while. And they'll leave it for potentially till November this year. And then we go, we start running. Now, to me, as I said before, I think we're there's two options here. One, we're in a bull what's called a bull trap, in which case there's still probably a long way to go up. The other option is that we really are past this bear market, and I believe that Powell has engineered a good landing, a soft landing. It's not the softest landing in the world, but it's kind of like where it came from. It's good enough, and I don't think that the landing is quite finished yet. I think we're going to slip a couple of bumps along the way, but I think for all intents and purposes, we are entering a new cycle. And I say this all with one disclaimer, that everything else remains the same. Everything remains ceteris paribus. The war in Ukraine doesn't escalate, that nothing happens in China, etc. I think we've turned into a new era. I don't think that it's going to be a straight run up. I think it's going to be sideways, up, down for a little bit, and then usually 100 to 200 days after the bottom, that's when you start getting great runs up. I had a very interesting segment on my show where we looked at what happens after the bottom to Bitcoin. What happened the last 3 cycles to Bitcoin after the bottom? And you kind of see that somewhere between 100 and 250 days after the bottom is when you get the real aggressive run up. So that's the thesis. We said it before FOMC. We continue to keep that thesis.
I'm just having a look now that Bitcoin, I looked at Bitcoin and NASDAQ. NASDAQ is relatively stable after it's sitting at 2%. And then Bitcoin is still going up. It's sitting at 2.5%. So we're seeing risk assets do well after this. So we'll see, man. Again, that does imply that all else remains. Whatever anyone's saying on this panel is based on current conditions. So if something happens in Ukraine, something happens in China or within the economy, that changes things. But are you, so Rand, before going to David, are you, bullish? Are you starting to make some moves, some bullish moves, buying up some Web3 assets, or too early for that?
Well, let me ask you, if you look around in your crypto circles, what's the biggest thing that people are saying right now? They're probably saying, as soon as there's a dip, I'm ready to buy back. Is that the sentiment? Am I getting it right? I missed this run, but as soon as things pull back, I'm going to jump in, right?
That's a good indicator that, we're not going to drop.
Yeah, that's a good indicator.
To Rand's point, last cycle, there was a bull trap right around this time. And I'm sure that Rand, that's probably why you mentioned it.
Say that again. Sorry, you cut out for 1 second.
He said in the last cycle, about the same time as now, in the last cycle, we had a bull trap. So that he's saying that's why you probably mentioned it, Rand, if history repeats itself.
Yeah. Look, we could get a bull trap. My calculation says that the things that I'm investing in, I'm a relatively long-term investor. And if we do get a bull trap, I believe that we are going to recover. Now, you may be right and I may be right. So if this is a bull trap and I've bought, what happens in bull traps is we're relatively near the bottom now. Then we rally, and we could rally even as much as 50, 60, 70, 80%. These bull traps can be really aggressive. And then you can come down again and you can maybe touch the lows and maybe go slightly below the lows. If you look at the last one, it went slightly below the lows. I know I'm not going to get the lows. Like I know that I'm not going to be able to pick the bottom. I never have. So to me, I'm buying it now because I think it's close enough to the bottom than it is to the top. And if we do get a bull trap somewhere along the way, and and we go in 3 months' time, like the previous cycle, we go back to close to the all-time lows, I'm still comfortable that my risk return profile is I'm buying it closer to the bottom than I am buying it to the top on the investment horizon that I'm holding. If I'm right, however, and it's not a bull trap, then I may have bought close enough to generational lows, because I think that what we've witnessed now, specifically in crypto, where we've had, the one thing that can really destroy markets is bad conditions. The one thing that can really, really, really destroy markets is a forced deleveraging under bad conditions. And we had both of those. We had bad macro conditions, which Bitcoin hasn't had in a bear market before. And on top of that, you could say that crypto blew itself up. Like you could say that, if you look at what crypto did to itself, we were our own worst enemy. You combine that and you realize that maybe 15,200 was really, really oversold territory, which is why we bounced back so quickly from 15,200. And now we're back above pre-FTX levels. So to me, look, am I closer to the bottom than I am to the top? A lot. maybe Bitcoin will go back down to 15,000. There's no guarantee, in which case I lose $8,500 per Bitcoin if I'm buying it today. But my upside is I'm expecting $100,000 in the next cycle. So my upside is 73. My downside is 7. It's a 10 to 1. It's an asymmetrical trade. It's completely an asymmetrical trade. That is on Bitcoin. If you start looking at the Web3 players, which Mario spoke about, it's like an elastic band, which is highly leveraged. If Bitcoin goes up to 50,000, some of these altcoins can maybe do 50x. And so to me, I know I'm not going to time the bottom. My thesis is that we have bottomed, and I think it's going to be choppy and sideways from that. But you may be right. And if you're right, I'm still confident that my strategy yields the same results in 2 to 3 years, which is the investment horizon that I'm taking. So, that's the way I see it.
Wahid, I have a question for you. I know you have to jump off for 10 minutes. Can you answer the question now when you come back in 10? Because I don't have, it's been a while. I haven't had you and Ran on a space together, so I'm geeking out a bit.
Go ahead. What's up?
One question, and then you can go take your 10-minute break. Wahid, if you're sitting on anyone that's sitting on dry powder now, I just muted you, Ran, just because you got a bit of feedback. If anyone's sitting on dry powder right now, Wahid, what's your advice to them today after this? You're muted.
So any asset class?
Any asset class, not just crypto.
Yeah, I mean,
and
okay.
any asset class with a bit more focus on crypto, because I'm looking at the audience, a lot of crypto guys.
Okay, yeah. For me, it's very simple, right? I look at where markets have rallied. If we're trading at 20 times earnings, which is what I think earnings are this year, 200, 210, where the S&P 500 is, I think is full. I think bonds are extremely rich. Wouldn't touch them. I would be focusing on hard assets. I'll be buying real estate, cap rates 5 to 7%. Because I believe the yield curve is going to be ultimately right. I believe interest rates are going to start dipping in the future. So I want to own hard assets. I want to own silver, gold, select crypto that have real utility and serve as a good inflation hedge long term. And if I had to select equities, I would do selective equities, right? Hard asset equities, solid dividend yields, etc. I wouldn't be chasing everything here today. That was last summer. I was harping on being long risk assets. Today, I think the name of the game with dry powder is to be extremely selective.
Wait, I want to ask you a question. If I'm coming into crypto today, if I'm a listener here, there's 6,500 listeners. If I'm coming into crypto today and I've got my portfolio well segmented and I've got a allocation of my portfolio in crypto. So let's say that out of my portfolio, I've got $10,000 which I've allocated to go into crypto. Okay. What percentage of that $10,000 would you be invested, or would you invest right now? Out of the $10,000, what would you invest right now? And the reason I'm asking is I kind of want to get a feeling for how risk on you are. And there's going to be another question after. So maybe just answer the first question first, and then we can talk about the next question.
So how risk on? So not, I mean, for people who heard me, I was extremely risk on last summer. Today, I'm more subdued. I'm more selective, right? So now I just want toll booth. Okay. Think of the highway. You're on a highway. The best business on a highway or in general is a toll booth. You got to cross that bloody toll booth every day, maybe twice a day, and you got to pay your toll. And so I want businesses that have, a toll booth aspect to it, right? Free cash flow, so that and some pricing power. So I love real estate. I love hard assets. And when it comes to crypto, I want projects that collect tolls, that have a utility where every single day you're burning the token in order to create shit. So I am, that's sort of the idea. And so in terms of asset class, you're asking me how much would I allocate if I had $10,000 to crypto?
No, it's like if
to
you
be honest,
had allocated $10,000 to crypto, what percentage of that crypto would you be in the market?
If I had, like, how much I would, so if I had 10,000 allocated to crypto, I'd keep it. I mean, crypto is incredibly lagged, and there's so many amazing projects that have a lot of utility that are, instead of being down 90%, they're down 80%. I mean, who gives a shit? So absolutely, I view it as very opportunistic.
So if you said, okay, listen, I've got $100,000 portfolio, which includes all my stocks, bonds, equity. I've taken 10% of my portfolio to allocate to my entire crypto holdings ever. I'm never going to put any other money into crypto unless it's profits. And you had $10,000 in cash and you were going to allocate money today. How much of that $10,000 would you invest and how much would you hold on the sidelines waiting to invest if there's a dip or for another cycle?
Okay.
The reason I'm asking,
Yeah. So crypto, I would. So very, very good question. So just so you know, if I have free cash today, and I do, every dime I do free cash, today I view crypto as an incredible buy because there's a lot of great opportunities that are highly distressed that have real utility. So crypto is not one where I'm trying to time the market and wait for a better opportunity. There's tons of opportunity today. Now, if I had a lot of cash and I wanted to deploy it into the stock market, I would be a little bit more patient and far more selective. I wouldn't touch the bond market here. By the way, I just looked at the statistics. We've never had as many shorts in the bond markets as we have today. So I feel people are going to get creamed and interest rates probably go down. So you'd think that maybe the market is technically going to pop, but I'm not in that business because I still think bonds are very, very richly priced. But I do think tactically bonds are interesting given that they've, there's a lot of shorts in them. But to make a long story short, I would be far more selective in the stock market. I would be less selective on crypto because there's so many great projects that are still highly distressed in terms of pricing, very, very cheap, right? I wouldn't be looking at Bitcoin versus some of the other more opportunistic things today. And I would look for real estate. There's a lot of great real estate out there that I think is very interesting.
I don't know if you guys have seen, but I don't know if you spoke about it, but Meta beat earnings and now they're up 20% or 18% on the after hours market. So that's another good sign for risk assets.
Yeah.
Meta's out of their problem.
They announced a $40 billion buyback as well.
Yeah, 40 billion buyback, but also, it just was the reason why is because so many shorts piled in since last 24 hours because of Snap's earnings yesterday. So I think you're seeing a huge amount of short covering, but still, it's not as bad as it was feared.
Right. So I do want to ask the panel a question here, and I'm going to go to Rand first. Back in 2020, 2021, especially when Joe Biden became president, there was a lot of pressure from the left on the Fed to keep interest rates at near zero. There are a lot of people that would argue that keeping interest rates near zero for so long and the fact that the Fed was calling inflation transitory led to the problems that we're having right now, where they have to keep spiking interest rates by, I think, correct me if I'm wrong, but interest rates were raised by 75 basis points 4 times in 2022. Do you think that had a lot to do with what we're seeing right now? And was that politically motivated? Did they succumb to pressure?
So the official answer is that the Fed is obviously separated from the government, and that's
right.
That's just the official answer. Unofficially, you got to think of the Fed as a defense mechanism against collapse of the markets. Now, if you take if you take interest rates away from them, if you're on zero interest rates, effectively what you've done is you've put the Fed in a position where they need to defend the health of the economy, but they have no weapons, because they have 2 weapons. The Fed can either put money into circulation or increase and decrease interest rates. That's the 2 levers that the Fed's got, and they can put money into circulation by various mechanisms. But that's really the 2 levers that they've got. So think about what happened. The pressure did come from the left because of COVID, because they wanted the economy to look like it was doing well when people were suffering through COVID, etc., because there were all these shutdowns. And so there was pressure to keep it at zero. But it's logical that the Fed would want to increase interest rates as much as possible, because that's almost like leverage that the Fed has in the market. So they want to just keep us out of recession. And then they want to have as much leverage on the market. You can always drop rates. You can always drop rates until you get to zero. And so the higher they are above zero, the more bullets they have in their magazine that they can fire when they need to fire to protect the economy. And that's that's I think what happened, and I think that now they're in the process of like refilling their armaments, and I think now they're in a comfortable space. I think like where they went to today is in a comfortable space, and I think there'll be one more, and then I think they've got then at 5% they've got enough leeway. Like at those levels they've got enough leeway. They can do whatever they want.
Right. So David, I kind of want to ask a similar question to you. There were so many people, the vast majority of economists, and even the layperson was shouting out that Joe Biden and the Fed were overheating the economy by continuing, stimulus packages, printing more money. Why do you think Jerome Powell was on the opposite side? Do you believe that his sentiments and his statements were genuine, or do you believe that he was succumbing to that political pressure?
So
I do. Before I want to add on to what Nick said. Just two things. I think perfect timing, Nick. So while we were listening to Powell speak, I got these two updates from the team that I was waiting for the right time to say them. The first one's Biden wants to hear House Speaker McCarthy's plan for U.S. deficit spending, and then White House spokeswoman Jean-Pierre, Biden is willing to talk about ways to cut the deficit. And that was not related to the FOMC press conference, but was sent to me at the same time. So I'm guessing they were announced at the same time. Go ahead, David.
So what's really important is back in 1974, Nixon implemented very strict rules for congressional and Senate maneuverings within, let's say, emergency budget acts of the deficit. And then when we go into 2008, the 2010 Pay-As-You-Go Act gives precedence to the Senate and to Congress to implement emergency deficit, and that emergency deficit will always be stimulated. Now, if we go into 2021, there is a new law enacted within that provision, Law 26111, enforces a disability for the monetary policy, so the Federal Reserve, to implement any forms of mitigations within 1, mainstream lending programs, 2, municipal debt divisions, and then 3, private creditations from corporations. And these are all emergency implementations restricting the Fed's ability to, let's say, mitigate inflationary pressures felt within the actual economy. And I think that Ron actually brought in a very important point in that sense, where monetary policy is very limited within actual abilities to influence inflationary pressures. And then Nick, a beautiful point in the sense that the big problem is the fact that since 2008 all the way up to 2019, where we saw the first levels of a maturity of the balance sheet and an attempt to do QT, and that being reverted because essentially it was really damaging. But the one big problem is the low rate environments that we've maintained for an extended period of time. And when low rate environments are maintained for these types of extended period of times, it gives an illusionary type of participation within your investing sector, specifically in your non-competitive fractions. When we think of institutional players, they are very non-competitive by definition because they have a index type proxy. And so to finalize the whole point, essentially now these low rate environments shifting into higher rate environments give the impetus of volatility towards actual stocks and or other forms of equities, and a debalancing and or de-risking for institutional players.
So I know with Nick, you've got a few questions from the audience, and any audience that has more questions, bottom right corner. But I've got a question. You know how every show they say not financial advice, not financial advice. David, since you're speaking, I want you to go first. I wish Rand was still here. I'll try to get him back. But David, I want you to go first, and I want to go to every speaker. Can you please give us financial advice? In other words, what do you recommend for people to do? Obviously, it's not financial advice.
So
Legally speaking,
that's important, and I'm gonna say it very conservatively. I think that the yield curve inversion that we're having is very important. There was a prior speaker asking a question why we're seeing such an inversion. To finalize that point, since 1994, there have been 4 periods since Greenspan that Fed funds futures have front run the yield curve, specifically 10-2s, and the actual Fed funds rate can only has the ability to artificially stimulate the lower end of the yield curve. So essentially 2 years, 2 months, 3 months, and so on. So when we're looking at the actual abilities for individuals to participate within these markets, and I'm going to refrain it in this type of manner: preservation of wealth, make sure that you're able to maintain the credit compression that you're going to see. Most people don't calculate for 29% interest rates on their credit cards, an increase of 200% payments on their mortgage payments, and then their auto loan delinquencies. And then from there, I revert into, if you do have any form of capital that's available to maneuver, think about yield. Think about, if I could yield some low risk asset or low risk T-bills, I-bonds, and other forms of developments, then you're in a preservation of wealth type mentality. Until we have a fundamental shift between the relation of Fed funds rate and the actual treasury rate, there is no conducive situation where a slumpish economy is not going to be over. And essentially, this slumpish economy is going to be continuing. Until we have that moment go, I don't think it's a relatively healthy environment for basic retailers to participate in. Apologies for that, Mario.
All right, so I've got a few quotes here. I'm going to read out just different opinions on what we just saw today. So Mike from Morgan Stanley Global Investment Office: as expected, the Fed raised rates by 25 basis points as the debate for investors has shifted from the size of hikes to when they will no longer be ongoing. Despite the market's initial reaction, it seems like the hike was priced in for the most part, as we see a slight step back from January's bear market rally. By the way, anyone in crypto, Bitcoin is doing probably the best right now among the asset classes. Just looking at it, still going up. Remember that while inflation may have peaked, easing isn't the same as evaporating. It's an important point. And with each month that passes, the Fed may be getting closer to pausing rate hikes, but that's not the same as pivoting to rate cuts. Big difference there. Investors should likely prepare for the possibility that the volatility that dominated last year could re-emerge, even if 2023 turns out to be an improvement from last year. Then we've got here Chris Anstey. On the debt limit, Powell said he believes Congress will end up acting to raise it. Quote, we, of course, will monitor money market conditions carefully. And then we've got here, Chris also says, Powell says the Fed monitors financial conditions carefully. He reiterates that the language he used earlier and in December, that it's important that conditions reflect Fed tightening. He notes that there's a difference of opinion about how fast inflation will come down. Quote, we'll have to see. Here we've got Steve Matthews, Fed reporter. There are a number of reasons to expect positive growth will continue, Powell says. The global picture is improving a bit, he says. As inflation comes down, sentiment will improve. And now here we got another reporter. Chair Powell's opening statement sounded somewhat more hawkish, but our sentiment model, see below, was more dovish. There were fewer hawkish comments and more dovish comments. I think we know that as well. Any more updates, I'll keep sharing them here. But I'll let, on that same question that I asked earlier, I'll go to Joa, and then we'll go, I'm not sure if Wahid is back with us, but Joa, what would be your financial advice to the audience? Not financial advice.
Not financial advice. Look, I'm kind of in Rand's boat. Like, I'm not trying to time the market. I was talking about technological advances. I think there's going to be a huge boom like there was in the 90s. It's what really started the whole .com bubble, the whole .com run up in the 90s. You're literally cutting costs of transportation to less than 10% of what it is today. That's going to have a huge impact. There's going to be a lot of cash around. Assets are going to be tokenized. With tokenized assets, you're going to have more money in the market as well. There'll be more liquid money. So I wouldn't.
So you're not saying much. You're not worried about You're not worried about liquidity crunch.
No, not at all. I think we might see a dip, but I don't like Rand. Maybe we go to 15, but why do I care? Like I'm looking 3 years down the line. I think liquidity is going to increase, not decrease by the end of 2023. We'll start to see the sign of it increasing. So I'm not really worried because I'm looking at what's going to happen with technology. And that's a huge differentiator.
We'll go to, we've got here entropy dynamics. First time you're on stage, I thought I'll bring you up, having a look at your profile description, your thoughts and your advice for the audience on what you just heard.
Yeah, absolutely. Yeah, absolutely. Thanks for bringing me up. I just wanted to mention that absolutely nobody knows what's going to happen. Things are incredibly uncertain with the yield curve inversion, the debt ceiling, and even the concept of a recession. These things are starting to form a narrative. But the recession component specifically is particularly subjective. when you consider that the numbers that are used to determine a recession are manipulated by the government, and the definition of a recession and things like inflation have changed over the years. So with all that being said, and especially because people are talking about financial
But was
advice,
it? Sorry, I don't usually interrupt, but wasn't that already priced in? I just want to keep saying the markets are forward looking. Hasn't that already all been priced in? What we saw, the correction we saw last year.
yeah, I would argue that markets are forward looking and it is priced in.
All right. Well, that's a positive note. Are you more bullish then or bearish?
I really don't look at things too much in terms of bullish or bearish. I kind of just hold the assets that I have the strongest conviction in, and then I let the chips fall where they can. I think you can find edges in terms of looking at things like when a particular volatility derivative is substantially underpriced. I think you can kind of take advantage of those opportunities. But in terms of just broad narratives, bullish or bearish, that's not me.
If you don't mind,
yeah, Mario, I think you have your mic muted. But yeah,
Oh shit, I'm talking about. Yeah, I'll let David just before you jump in. Just one thing. The audience, a lot of questions from the audience is about external factors. A lot of people talking about the war, talking about the tensions in China. Let's pivot to that, because I said before, excluding external factors. Let's look at external factors. If we see peace between Russia and Ukraine, I know a lot of people find that to be a bit far-fetched, or we see an escalation there, or we see tensions in China. What do you expect outside Fed decisions, and how do you think that will impact the market over the next few months?
Yeah, and let me add to that real quick, because a lot of people will argue that the $113 billion, actually it's going up to $118 billion once they pass this new, once they send more money to Ukraine, which was announced yesterday. A lot of people argue that this does not actually contribute to inflation. So is that an accurate statement, or is that a total farce?
Yeah, so I'll let Wahid and then David answer this question, and then we do have two special guests coming in. They did a space earlier, really good space. They're going to come in and tell us the recap of their space and what the sentiment was there. Same way Rand did earlier. Just to get different sentiments from different speakers and different shows and spaces as well. Get them all to give us an overview here. So I'll be bringing them up in the next couple of minutes. But otherwise, Wahid, would love your thoughts on any external factors, Black Swan events, good and bad. And then we'll go to David, and then we'll introduce our special guests.
Yeah, okay. So look, in summary, I felt like positioning, sentiment, valuations, etc., 6-7 months ago were a lot better. So you had a lot more room for error. Today, I think you have less room for error. Okay, everything is always priced on the margin, all right? And so you just have to be very selective. And so today, just look at the DAX. Okay, the DAX is Germany, the most exposed in terms of liquid large market to the Ukrainian geopolitics. I can look at the geopolitics today and say we're no longer worried about natural gas. I think that's an error. I think yes, the storage is much higher than it was expected, but still you have no pipeline deliveries coming from Russia. So if this war drags on for another year or 2 or 3, it's going to be very hard to refill that storage yet again for another year. So again, where we were 6-7 months ago worrying about gas to where we are today not even thinking about it, I think is not warranted. A lot of cyclical sectors in Germany and Europe. Again, I don't think they're discounting the stagnation of earnings, if not decline. And inflation is going down a little bit, but it's going down from 11% to 8.5%, 9%. Hardly something to celebrate. So again, I was extremely bullish, but then I look at the pricing today, and I look at the geopolitics of Russia looking to ramp their war in the next 2 to 3 weeks, and I just don't feel enough risk is discounted. So that's what I say when you look at geopolitics. It's not a geopolitical event in and of itself. It's what's being priced on the margin, and I just don't think Europe is pricing in enough risk. It's actually quite euphoric. Same thing in the U.S. I think debt ceiling is real. I think the bipartisanship is at a level that I think people are no longer discounting as enough risk in the market, and the Fed might be closer to pausing, but at the end of the day, you're still doing 90 to 100 billion in QT per month. You still have a shitload of supply of debt that needs to be absorbed. And then when you layer on a debt ceiling, partisanship and fights, I just don't think enough risk is discounted. And so across the board, I think where we are today, one has to be very careful and selective.
I want to go to Stock Talk Weekly. I'm not sure. I can't remember if you allow me to mention your name or not. I'm not sure if you're doxed, man. But you've done a great space as always on this. You do a lot of spaces, a lot of economic and finance spaces. I'd love your take from your panel earlier. What was the sentiment like? What are your thoughts on the decision today and on the press conference, and your expectations moving forward? Go ahead, man. Good to have you again.
Yeah, man. Thanks for having me. Wow. I mean, I can take this very broad. I don't know how specific you want me to be. I can take this broadly. I don't know how.
Let's kick it off. Let's kick it off broadly first. We can get
Okay.
into specifics afterwards. And the sentiment is like we had a few panelists come and go. The sentiment is generally more bullish. I think Wahid was a bit more on the bearish side, but moderately bearish. Would love your position and your take on everything.
Yeah. So, okay. I mean, it's going to be very difficult for me to do this without being long-winded. So I'll take the liberty to be long-winded here. But I've been trading equities markets for over a decade now. I still consider myself to be pretty young, but at the same time, experienced. Trading a non-normalized monetary policy environment, which is what it's been for the last 3 years, is tricky because even though you may not be a macroeconomically focused trader, there's a lot of traders that I know that are just day-to-day traders that are entirely technically focused and don't concern themselves with the macroeconomics. Even if you are one of those people, usually in bear markets, it becomes imperative to even have any kind of idea how to navigate markets, to be at least somewhat macroeconomically literate. And so, I think a lot of the narratives that are spread, especially by people who started trading or who started participating in markets in 2020, really just lack the lens on the structure of how central banks work, and especially how our central bank works, and end up misleading people. So that being said, I'll talk about the notion of a pivot, which I think has started being entertained last year, but has been more so entertained this year. I'm going to pin a post at the top that should give some context for people that don't have maybe the historical context necessary to try to analyze these things. But I pinned a post, shows a chart that shows exactly what happens historically following a pivot in the Federal Reserve. And when we're referring to a pivot, that's another term that bears definition, because there is a misconception about the difference between a pause, which is the Federal Reserve stopping the shift of policy, versus actually cutting rates, which would be policy in the other direction. And so on that chart specifically, when referring to pivots, you're referring to the Federal Reserve proceeding to cut rates. And what you'll find is in the last 6 instances that the Federal Reserve cut rates, the market actually saw more downside following the pivot than it did headed into the pivot. So that's an important.
Someone said this. Yeah. So Stock Talk.
Yeah.
Someone said this, and then someone else corrected him afterwards. Wizard corrected him, like it was correlation, not causation.
Well, yeah.
So is
I'll
it
give
actually?
I'll
Okay.
give the
Thanks, man.
context that's important. So the reason it's important to look at it contextually is that, and what people will say who dismiss this notion, is that in the previous examples, there was an outsized market rally headed into the pivot, which then gave you the balance room, if you will, to allow the market to let off excess speculation headed out of the pivot. The second important part is that typically you get a pivot in response to deterioration of economic conditions, right? So Federal Reserve policy, central bank policy in general, usually acts off of a stimulus. It's very rarely predictive or proactive. It's generally reactive to a stimulus. So, for example, on the easy side of this cycle, the stimulus was COVID and the global economy shutting down. And on the tight side of this cycle was the price stability narrative, which obviously some people refer to as inflation. When you're looking at the U.S. Federal Reserve, you're looking at structurally a little bit of a different decision-making body than other central banks globally. So when you look at other central banks globally, 99% of central banks, the Reserve Bank of Australia actually functions how ours does, but that's besides the point. 99% of central banks function purely off of their association with price stability. So they function entirely off of the idea that their primary mandate is to maintain price stability in both directions. The United States Federal Reserve is a little bit different. We have more of a balancing scale. We're what's referred to as a dual mandate central bank. And so the United States Federal Reserve, you have to maintain not only price stability in the way of inflation, but you also have to maintain maximum employment. And this is where the curve for US monetary policy is a little bit different than it might be for other central banks globally. It's the notion that you have to maintain room in the labor market while you are pursuing corrective action on price stability. And right now, that's why the eyes have been on the labor market in the last 6 months. So the eyes were on new JOLTS openings today, which printed, I think, 11.01 million versus 10.3 million expected. So, an extra 700,000 job openings that weren't expected today. Market didn't like that initially. Obviously, Powell's rhetoric kind of changed that narrative, and we ripped into the close. But what?
I want to ask you a question real quick on that, if you don't mind.
Sure.
Senator Elizabeth Warren, as well as Howard Dean and 9 other U.S. legislators, came out actually back in November and said we will lose millions of jobs if the Fed continues to raise rates. And since then, we've actually had several rate hikes. Is that still something that's in the cards, something that can be expected, or do you think that's a total political farce?
So I don't think it's a political farce to say that we're going to lose jobs. The intention of this side of the monetary policy cycle is to affect employment. That's quite literally their intention. And so, that's also why I'm dismissive of the notion that some people say that the Fed is going to make a nuanced decision. Like, when you look at the Fed structurally, and this is the point I was alluding to earlier about us being a dual mandate central bank, when you look at the Fed structurally and you put that in a historical context, they are destined to overshoot. I mean, the central banks are just built that way. In the US, the situation is actually exacerbated. Well, this isn't really just in the US, it's globally speaking. Inflation data is lagging globally. So our month over month data lags by a month. Anyone who's looked at CPI data knows this immediately, right? You get in January, you don't get January CPI, you get December CPI. Now, here's why that's an issue structurally. The Federal Reserve is operating to achieve a benchmark, okay? Now, that's a moving target, but nonetheless, it is a benchmark. Those benchmarks are their definition of maximum employment, which is a shifting definition. There's actually no objective definition of what maximum employment is, which also makes this situation increasingly trickier. But the second benchmark is their price stability benchmark, which in this case is not a moving target. They've set the target at 2% inflation, right? So on the inflation side, we know their fixed benchmark. On the maximum employment side, it's more of a moving case by case. Hey, we'll analyze the labor market as we move and make that assessment. The issue is because they're reacting to lagging data in order to make a decision about a benchmark, structurally that equation just does not work. And that's why in the 13 rate hike cycles we've had since 1947, 10 out of 13 of those cycles have yielded a quote unquote hard landing. They've yielded a recession within 24 months of the first rate hike. So we're still within that window if you're to use the average time frame. But yeah, the Federal Reserve has a lower, I often use this analogy, the Federal Reserve has a lower soft landing percentage than Westbrook has a 3-point percentage. So it's a good way to think about how bad they are.
I want to quickly give an update. Nick, just quick update before we go to entropy. Just quick update from my end. And Wahid, you might like this update. You with us, Wahid? Wahid, you there? I'm gonna give you a good update, man.
Wahid, yeah, I'm here. I'm here. Sometimes I can't click fast enough, dude.
Yeah, all good, man. All good. I've got the update right here. So just to let you know, I know that me and you have exposure to everything. You own like 100 companies, but I have a big exposure to crypto, and crypto's just going up and up. So it's just looking good, and I'm hoping maybe get a couple of crypto guys here anyone, all the regular panelists on our crypto shows, maybe jump in for a bit. Goody, I see in the audience. Maybe get a couple of macro guys from crypto. I don't know if Plan C is still with us. Let's do like a 10-minute segment on crypto because it's doing pretty well. NASDAQ is relatively steady after a small, so it's still sitting at 2%, but Bitcoin's already at 3.4%, which is great to see. So that's the update I had on my end that I wanted to interrupt and mention, Wahid, to make you happy. But yeah, sorry, Nick, I'll give you the mic back.
No, it's okay. So Entropy, I saw you raise your hand during that. So if you can address that point and go ahead with it, whatever you wanted to.
Sure. Yeah. I just wanted to add on one thing about the jobs number and kind of speak to my initial point about how and why these things are so hard to predict. I think the last speaker was 100% spot on in saying how the definitions of these things change. But when you look under the hood at the actual metrics here, these are horribly flawed metrics, right? Because you have countless people working multiple jobs. You have countless people who are working like 4-gig jobs in place of like one permanent, job that would be listed on the numbers. So I don't really have, I wish I had guidance about kind of like how people can navigate that. But I think it just goes back to my point that
I've just got a bit of breaking news. We do usually interrupt when there is. So Speaker McCarthy, maybe you can comment on it, Entropy, since you're speaking. Speaker McCarthy just said the US debt is the greatest threat to America. This came out literally a few seconds ago. So again, the US debt ceiling is the greatest threat. US debt, sorry, is the greatest threat to America. And then another comment here about a possible trip to Taiwan. And he says, I don't think China can tell me where I can go. So we're just talking about other factors that could play a role in all this. Well, he is about the Taiwan-China tensions, which don't seem to be easing. And then you've got the U.S. debt, the comments on the U.S. debt. So, I mean, going through any more updates. But yeah, go ahead, man.
The China-Taiwan tensions at this stage are I think you have to separate the geopolitical equation a little bit here and decide which aspects of the geopolitical formula today actually have a true inflationary impact. Because Morgan Stanley put out an excellent note to start the year, which is probably one of my favorite institutional notes to start the year, which was that the market spent most of last year concerned with price stability. And the market will spend most of this year concerned with growth. And the idea that the market juggles different narratives and prices based off different narratives is true. It's very rare that the market is operating off of one narrative in a vacuum. But what is also true is that the market tends to prioritize narratives at different times. And last year, the priority was the inflation narrative. All of asset markets globally were focused on that, including bond markets. So there was a tremendous focus on price stability. And now, I think especially after Powell's comments today, there is a euphoria around the notion that if you were to extrapolate the month-over-month data, it looks like the war with inflation is over. Here's where that gets tricky. You can't conduct that level of rudimentary analysis and make any sort of meaningful conclusion here. Because if your analysis is purely, I'm going to take the 3-month lagging month-over-month data, annualize it, and make a prediction of where inflation will be a year from now, you're assuming that there are no other net inflationary or net deflationary impact or factors at play, which is plainly untrue. The main factor, the main thing to be concerned about globally for price stability is the reopening of the Chinese economy headed into the summer. Now, there's a couple factors there that make that analysis difficult. The first factor is what are the degrees of separation from the consumer and the Chinese economy based on the zero COVID policy versus today. And what I mean by that is, to what extent was consumer behavior restricted during the zero COVID policy? And to what extent will those restrictions now be lifted? If, and again, this is an if, it's very difficult to make this conclusion without a tremendous amount of consumer data, which is, again, difficult to get from the CCP. But if you could make the conclusion that there will not be a meaningful change in consumer access as a result of this reopening, then you can say, look, it's going to be a non-issue. It'll likely be have a minimized inflationary impact. And globally, you'll be able to thread the needle in the summer through the Chinese reopening and emerge in what is still a disinflationary trend. I think the probability of that is very low. In my view, if you look at the Chinese reopening, the real risk here is that there are 700 million, quote unquote, and I'll put the quotes there because, again, the CCP data is hard to rely on, quote unquote, middle class consumers. And those consumers will buy more things. The question is, how many more things will they buy? And at what rate will their purchasing behavior be accelerated as a result of the reopening? The second component is how long full reopening will take. There's analysts that think that China will reopen in 45 days. There's analysts that think China will reopen in 200 days. So the view there is dramatically different as well. But the bottom line is the only way you emerge out of this summer with a handle on the inflation narrative is if Chinese reopening is not net inflationary. And by my math, I don't find a way to come to that conclusion. And I invite anyone else to challenge that. But I've tried every possible way to slice the numbers, and I don't see a way where 700 million additional consumers is not going to be net inflationary. That being said, can the deflationary impacts from additional refining capacity access, supply chains being greased, if you will those effects from Chinese reopening be enough to taper the net inflationary impact and lead us into a soft landing? That is the question of the year. And to me, you won't have a firm answer on that until about April.
I've just got a few updates, Stock Talk, a lot of things. So I'm going to first, before going to Jim for an update on McCarthy, and then go to Justin to play us a clip so we can comment on it. A few comments from CNBC. I do want to give updates from Double Nine's Jeffrey. So he says the following, just very quick. I believe we still have one more rate hike left, but the second one is interesting. Odds of a 2023 rate cut are a coin flip. Stock Talk, just very briefly before we go to Jim. What do you think are the odds of a rate hike? A rate cut this year?
Barring a massive economic collapse, this year is 0.
And I think I don't think it would be good news if they do a rate cut this year. I just think it would be too aggressive.
To me, the earliest possible scenario is Q1 2024. And that's a very sober monetary view coming from somebody that's traded equity markets for a decade. And I think I have a pretty deep historical knowledge of monetary policy. There's just no way. Anyone that's purporting rate cuts this year is implying that you're going to have an economic collapse in the second half of the year. And if you believe that, then sure, you can take that narrative to bed. But the reality is I don't see that happening, especially with the Q4 print out of Europe, especially with the labor market is where now and the Fed being more careful. I think you get another 25 bips hike and then a pause. And I think you probably don't see a shift in policy until early next year, maybe even middle of next year, where you might get a modest cut, and that too a modest one.
So
I'm going to go to
real quick, if you don't mind, Mario.
Yeah, sure. I'll let you ask your question, then we'll go to Jim because I know he's waiting to give us the breaking news from McCarthy. Go ahead, Nick. Sorry.
Shortly. So, Stock Trader, do you believe, or Stock Talk, I'm sorry, do you believe that that's enough? That another 25 basis point increase in the federal funds rate is enough to get down to their target of 2% inflation?
No, I don't. But that's not what's important. What's important is you got to think of this like an alarm system for the Fed. Okay, the first alarm that went off was COVID, so they eased, and we saw fiscal support as well. The second alarm that went off was price stability, and so what did they do? They started tightening, and they started QT, which they will continue. They're actually planning on continuing QT regardless of if they pause or not. So we know that stimulus causes action from the Fed. The issue that is happening here, and I see this all over FinTwit, I see this with my hedge fund friends, I see this with institutional people that have been in the game for 40 years, is this tremendous occurrence of what I view as paralysis by overanalysis. There are people that are deep diving economic data to look for red flags. The massive issue with that is that you have to expect that the Federal Reserve is going to do the same thing. Not only do you have to expect the Federal Reserve is going to make the same analysis, but you have to make the bold assumption that they're going to make a policy decision change based on this nuanced analysis. Any objective view of historical policy in the Fed will tell you the Fed is not a nuanced decision-making body. They have two very blunt tools in the way of QE, QT, and rate cuts. They use them aggressively and without abandon, and they very frequently, as a matter of fact, 80% of the time, break the economy in the process. And structurally, they're built to do this over and over and over again, regardless of who's sitting in the chair. It's not Powell's fault or anyone else's fault. It's structurally built to happen that way. You have to see economic pain to taper economic euphoria. That's the unfortunate reality of a boom bust cycle. We can debate the merits of and moral standing of monetary policy, but as long as we exist in this system, that is the destined outcome.
Yeah, so I want to give a few updates quickly. First, shout outs to just going through the audience. Your questions are sick. Special audience members, we've got Tara, who runs incredible spaces in the audience. We've got Goody, who co-hosts our crypto spaces. They'll be doing it after this space, him and Fidgetal. And we've got Brian, a regular panelist, among many other listeners. Thanks a lot for joining. Comments, bottom right corner. I do want to go to Nick. Jim. Jim, you've got a few updates from McCarthy, and then Justin will play a few clips for us so we can talk about them. Jim, what's the latest there? You've been listening to I think, Fox News streaming it live. Go ahead, man.
Yeah, and it's out everywhere. But Kevin McCarthy went into his meeting. He said it was an hour meeting with President Biden. As he's walking out, he did a quick press gaggle for about 10, 15 minutes. And he one big thing he says is they were negotiating on on spending because the debt limit is coming up, and he says he wants to try to get to an agreement as quickly as possible on that before the deadline comes so that they can start negotiating from there. We'll see how that is. I mean, I've spent 8 years on Capitol Hill right in the middle of these debates. In fact, I was personally making news by putting things together in previous government shutdowns, and it's always a very interesting cycle. But what's interesting is Kevin McCarthy right now trying to get this done. He's got a situation where he cannot lose 5 people in his membership of GOP members, or else they can't do anything. So he's got the pressure to put something together, but he also has the pressure of a president who knows that he's got his signature and a Senate in his way. If they bring Joe Manchin on board, which there was no mention of Joe Manchin, then that's the only way they can get this done. But basically, the outlines that he's throwing out there is, one, he's not going to negotiate in public about what the construct of spending cuts are. He did mention about having a long-term plan on that. So that's apparently something that he's trying to negotiate into this. He did make a brief mention about waste, fraud, and abuse issues. I think he's referring, he didn't say specifically, because waste, fraud, and abuse issues are important, but they're not a large dollar number. But I'm just curious if he's referring to the COVID relief fraud that we're starting to find out about, that to the tune of hundreds of billions, and what that might mean and how that might be approached. But that's kind of up in the air, and I'm sure no one asked him about it in this. Someone will ask him about it.
Yeah, Jim, I think you're spot on. That was what he was talking about today. Is the first meeting of the oversight committee. I have a small clip. Let's see if we can catch it real quick and see if we can just play part of this. This is McCarthy in front of the White House after meeting with Biden. We're catching it partway, but I think it's relevant.
I think had we not been elected to the majority, we wouldn't be having this discussion. The American people would not have an advocate here to curb the waste in the spending that's happening. So I think this is a positive. This is exactly how government in America is designed, that you have to find compromise. The American people made a decision to have the Republicans in power in the House. The Democrats have a small majority in the Senate, and the Democrats have a president. But we're all Americans, and we all have to work together. But the one thing I do know, our debt is too high. We have waste in our government, and we need to sit down together in a responsible way to put us on a path to balance that will make the future of America stronger, so the next century will be ours.
There you go. I think it's a pretty good clip.
Yeah, I think. Listen, this is going to be an interesting battle, and as it relates to what happened in the Fed meeting today, the Fed has been funding so much or putting the funds in place for so much of the debt that's been happening recently. That may end up being an interesting leverage point for McCarthy if he's willing to do it. This is what's going to be very, very interesting is if McCarthy himself is desirous to be aggressive. This is where the last two Republican speakers, Paul Ryan and John Boehner, they were willing to work with the Democrat president in both cases, Barack Obama, and not make deals. So McCarthy seems more determined. He's got a caucus behind him. If he's able to pull that off, just watch, because that can potentially help fuel economic growth and maybe even helping the markets moving forward.
I'll jump off to Wahid. Are you there? Let me just. I'm taking some messages.
Yeah,
here.
I am. Sorry.
Yeah. Any? Were you listening or no?
Yeah, I was listening. Got it.
Yeah. Anything to add? Because I want to go to Nick right after.
I think, I think they have a mandate to create a lot of noise 1 year pre-election, and they're going to take this down to the wire. Obviously, they're going to find some form of solution. The question is, what do the markets do up until that last final hour? And I just don't think the Democrats can cut a single dollar spending, right? You can't cut military because of the wars and what have you. But like, where are you going to cut? And entitlement spending is hugely entrenched, in the fringes of the Democratic Party and in the fringes of the right wing party, the Republican Party. They want, they want Trumpism. And so, given that the country is run by the two extremes, I just think we're going to have a very, very bad experience up to the last hour. And the question is, what are the markets going to tolerate?
Yeah, and what the interesting negotiating point may be here is not going to be specific cuts, but something along the lines of, will we stop the increases? I don't think we can be so ambitious as to get to deep cuts. I think that's going to be a challenge, and no specific program is going to be able to do it. There is going to be pressure on the entitlement programs, and Republicans hate having defense stay the same or even decrease. So that's where the focal point is going to be. And there are plans out there. I know over in the Senate, Rand Paul has some, but there have been some Republicans in the House that have negotiated it. If you can get something similar to what Paul Ryan was able to accomplish almost 10 years ago now, I guess 6 years ago now, 6 or 7 years ago now, that actually could be very helpful, and it would be perceived as a positive, even though it would be modest. But yeah, you're right. You're not going to see big cuts in certain areas.
You didn't have the tribalism as you have now, right? It was Barack Obama, obviously. The Tea Party had just emerged, and it was just the beginning of the extreme tribalism we have today. But it's nothing like what we have today. And you're 1 year into a presidential election. There's not a clear contender for Biden on the Democratic side. Is he or is he not going to run? No one knows. Kamala Harris is extremely unpopular, right? And there's no contender. And then on the Republican side, it's a race towards who is more, who can out Trump. And so when you think about just the political landscape, there's not a single mandate on both sides of the aisle to have any single concession. So I just don't. This one, unlike in 2011, this one is tougher, much tougher. Okay, and we're starting from a much higher place in terms of interest rates and where the debt is. So I think this is a risk that the markets are not adequately discounting, because they just take it for granted. They say, oh, they're not going to be stupid. They're going to come up to some concession. I think the risks are not discounted.
Yes, I see that, Jim. Nick, I'll give you the mic just a sec. Justin's going to come back with another clip to play for us. He's getting ready a few clips and reactions from the market on the decision. He's just fixing a bit of a technical issue, and then he'll come back with a second clip. Go ahead, Nick.
So Wahid, I just want to make your sentiments clear here, because there was a reporter just now that asked Speaker McCarthy, can you commit that the U.S. will not default on its obligations? His response being, if you have a child and you give them a credit card and they spend that limit, you're responsible for paying that credit card. Not just raise the limit, but look at how you're spending. Do you see this becoming like a showdown in once it gets much closer to the time where
Well,
they're forced to raise the debt limit?
So, McCarthy is actually very middle of the ground, extremely. Remember what he just negotiated. Remember, to get speakership, what he just negotiated. A single member of the Republican Party can ask for a no confidence vote. A single member. He is hanging on a string. He does not lead the Republican Party. And Biden does not lead the Democratic Party. Okay? So the fringes run the show. I wouldn't call Joe Manchin a fringe on the Democratic Party, but he has ultimate veto power.
I want to quickly. Sorry, I'm just going to quickly jump in. Yeah, Jim, and Wahid, I think you guys gave a great political overview. I want to go through a few more reactions from the markets we got here. Pia Singh, she says the following: the Fed has moved past stage one, debating. No, that's not the one I'm going to read out. While inflation pressure have started easing, the Fed's work isn't done. She focuses on that quote, and that's from Bankrate Chief Financial Analyst at CFA. Interest rates are moving higher and may stay there longer than is generally believed. The improved hedging properties, and there's another one here, the improved hedging properties of bonds combined with higher income and total return potential presents investors with the most opportunistic environment in fixed income markets in more than a decade, even after the strong performance seen in January. That's Watson. No, that was earlier. That was before. That's not a reaction. That was earlier.
These opinions are a dime a dozen, Mario.
Yeah.
Opinions here are much better.
Yeah. I must have a look now. Justin's back with us. Justin, do you want to play the clip you had ready earlier?
Yeah, so this is Jeffrey Gundlach. He's the founder of DoubleLine, a management fund company. Let me just play this short little clip where he's talking to CNBC Overtime, and he's talking about his take on it, a little different than most. He actually thinks, well, I'll let him tell it.
Big numbers. You got the S&P up 8%. We've got the long bond, the treasuries up 9%. We've got emerging market equity up 11%. So unfortunately, I think that we've gotten a lot of return already for the first part of this year. And as we move forward a couple of months, I think we're going to start getting overvalued, because I think this inflation narrative that is so supportive of markets, we're almost, I almost thought that Jay Powell was going to use the word Goldilocks at one point. He seemed so comfortable with where he was. Weird how he, at the same time, had this aura of relaxation, and yet he did still talk tough. Jobs not done. We have to raise rates more. We're not going to stop. We can't stop too early. But for some reason, the mood sort of trumped, and that rhetoric just didn't seem to have the teeth or the intensity that he had last fall.
Yeah, I think you can sense that too. The teeth issue, where he talked at one point. Well, look, this is all about raising the debt limit, right? There is this famous sort of hot potato that goes between the Fed, Congress, the White House, and you saw it again and again during the pandemic. We're like, hey, this is my fault. This is the CDC's fault. This is these guys' fault, right? And you'll see it throughout the next few months as they try to argue on whose fault it is. I'm trying to queue up a clip right now because they were just having the presser with the press secretary of the White House asking her opinion on all this. Let me find a couple more clips, but that was Jeffrey Gundlach. And he kind of thinks that we've already spent our wad here in the beginning of the year, and that maybe he's over enthusiastic, Mr. Powell.
Yeah, by the way, Jeff Gundlach is not just any ordinary person. He is the bond king, right? Replaced Bill Gross, my former colleague at Janus. Gundlach has called the markets, right way more than he's called them wrong. And I think he said that there's just a lot of more exuberance here than there was 6-7 months ago.
So Stock Talk, I would like to have your response to the clip that Justin just played.
Sorry, I didn't hear the entire clip. What was the summary of it? Sorry, I've been closing
Justin,
out.
do you want to summarize it? Yeah, Justin can
summarize it. Basically, Gundlach was saying he felt that Powell was being a little bit over enthusiastic, and that Goldilocks kept coming to his brain there. That he thought we've already gotten a lot of good growth here in this year. He doesn't think that coming down the line we're going to see all that much boost from here, and that perhaps Powell is over optimistic.
Boost in what sense? In equity markets?
Yeah, altogether.
Yeah.
Yeah, I mean, I think that's not an unreasonable view to take. Yeah, look, best January for the Nasdaq 100 since 2001. So very euphoric kickoff to the year, especially for growth in tech. And do I think the trade got ahead of itself? Yeah. Do I think it still has legs? Maybe, but we're trading up based on attempting to bake in an eventual shift in policy. And I think where the narrative gets lost is that bulls don't know structurally, at least as far as it fits into their narrative, whether they want to pause or a pivot. And I think that those two events are going to end up being dramatically further away from each other than most market participants anticipate. I think, in my view, base case for a pause is 2 meetings from now. So, I think we get 25 at the next meeting and then a pause. Could that happen more rapidly? Might we pause the next meeting? Sure. But if that happens, I still don't see us cutting until, again, either very late this year, like the very end of the year. I still think that's unreasonable, or much more likely Q1 of next year.
Stock Talk, I've got another selfish question. Oh, sorry,
Okay.
Nick. Can I ask a selfish question to
Yeah,
Stock Talk?
absolutely,
And I go to just. All right, Stock Talk. And actually, I want to see from the audience if anyone else wants to know the answer to this. Like, I want to know how many people have exposure to crypto right now in the audience, because I have a big exposure to crypto. So I'm asking this question. What's your position there? I don't think you've got. Do you have any exposure to crypto, Stock Talk, or it's mainly capital markets?
Yeah, I mean, I'm mostly exposed to equities markets, but I mean, I do own a couple Bitcoins.
That's it. Any thoughts on the crypto space, or not really, not keeping up? Because Bitcoin is doing well, man. We're crushing Nasdaq.
Yeah, look, I mean, I imagine that most of your audience is more bullish on crypto than I am. I think blockchain has tremendous value as a technology. I think that there are going to be speculative bouts in which crypto will perform very well the same way that growth in tech does. I think it'll remain to be a speculative asset class and will remain to trade with speculative equities the way that it did for the last few years. Might there be some separation in price action, like deep into a bull market? Maybe. But in the early innings of a bull market, which is what we will be in if the tide shifts anytime soon, crypto will just perform like a speculative asset class. Its performance relative to the Nasdaq and the S&P 500 and a handful of other growth and tech stocks have kind of been a testament to that for some while. But really, it's a liquidity equation. There's a lot of people that talk about like these crypto cycles that happen, and I'm not dismissing the validity of that, but this cycle was almost entirely because of a withdrawal of liquidity, right? It's the punch bowl effect, and it really amplifies itself in every kind of economic realization, like even with labor, right? A lot of people are confused about like the way that labor unfolds during these cycles, and all the headlines you've seen with these mass layoffs are a testament to the fact that it happens in 2 layers. It's like an onion. The first set of layoffs are when the punch bowl gets pulled. You know, companies have to accommodate demand in a very fluid and hyper competitive economy like we exist in today in the modern economy. Companies have to, at least in theory, accommodate demand. The issue that's created by that in a monetary policy cycle is that monetary policy cycles, by their very nature, move to artificially affect demand. So what happens in the easing half of a cycle where you have QE and rate cuts is that there's a massive surge in demand, right? And that really happens effectively overnight. And we saw this exact phenomenon in COVID. You shut down the global economy, then you slash rates to zero, fiscally stimulated, and boom, everyone was buying fucking everything. People were paying $3 million for monkey JPEGs, right? So when you have that type of hyper liquidity, everything appreciates in value. It's the punch bowl effect. But then in the same way that you had this abrupt stimulus to demand, when Federal Reserve policy shifts, that punch bowl gets taken away just as rapidly. In the same way that you saw, a boner candle in demand on one side, you see this massive drop off in demand on the flip side. And what ends up happening is these companies, when they saw that artificial COVID surge of demand, what did they do? Well, if you have outsized demand as a company, what do? You hire more people and you expand production capacity. Two basic principles of economics. The issue is doing that temporarily. And that's what happens in every one of these boom bust cycles. You have artificially stimulated demand. The corporate environment responds to that artificially stimulated demand by building additional capacity and hiring more employees. When the punch bowl inevitably, because it always gets taken away, when it inevitably gets taken away, all of that excess capacity and labor infrastructure is now a burden to the business. It's a cost efficiency burden to the business because you no longer need that excess capacity. So you see what is referred to as like the first onion layer of those layoffs, and all of the headlines you saw last year. Spotify lays off 3,000, Meta lays off 10,000, et cetera, et cetera. So headlines all through last year. That was that impact. The headlines you're seeing this year on the labor side are the second layer of that onion, and that's earnings compression. So in the same way that I told you about the punch bowl effect and how that impacts it, the second phase of that is the earnings compression that happens as a result of tighter policy. So just 2 years ago, we were looking to stimulate demand. But now as we're looking to taper it in a way to fight inflation, there is a further domino effect to corporate industry. And that effect is that now their earnings compress. So in the year prior, where they were laying off people merely because they had to trim their excess production capacity, now they're laying off more people in response to earnings compressions, and the company's effectively losing earnings power. In which case you dramatically lower your workforce. So yeah, these effects are just basic macro, but when you expand it to asset classes,
yeah, I think one of the things that we're going to see here, especially, I'm here in California, and we see the bottom line of the state budget. We were, just crowing very highly with Governor Newsom there, very ecstatic about the $9 billion in excess when they had going. But I think what we're going to find, but the reason that they're now projecting major billion-dollar losses in the state is because all these big companies are lowering their corporate revenue, lowering their forecast, lowering their taxes, and that was a big part of the tax base. Let me play a clip from you, CNBC. This is reaction to the Meta outlook for Q1 and some of the statements that were made there. This is interesting because it's a little contrary. The idea. Well, let me play it, and we'll back to discussion here. This is Downtown, who is what's his name on Twitter? Downtown Josh Brown, right? CEO of Rich Wealth. Let me get to right here. Click on CNBC.
I'll make this very simple. You heard from Evan Spiegel at Snap last night. Use the term extremely challenging. The reason it's extremely challenging is because when people are pulling back on advertising, they don't pull back completely. They pull back to the platforms they know they can rely on. They stop experimenting. And so I actually think the Alphabets and the Metas of the world benefit from an environment where people are looking at, well, throw out the third, fourth, fifth, and sixth best option. Let's just go with what we know works. And that might have played into some of the strength that we saw out of Facebook's platforms tonight. I'll make this very...
Yeah. Look, this is a difficult thing to sort of get my head around. In many ways, you've seen the layoffs from Meta. I think Meta was up about 14% today, if I'm not mistaken, or maybe that was yesterday. But the issue that you have now is that when you lay off 10,000 people from Amazon, right, that's in your warehouse. Those are the people that are using Amazon as both the fulfillment engine and manufacturing engine. So all these Etsy shops you're going to see kind of peter by the wayside. And the people that have big bucks and savings, like Meta, like Amazon, like Apple, those guys will survive nicely. And it may be that this guy is right, that people, and I'm coming from a marketing background, they'll pull back to advertising they know can work. But I guarantee you that there's going to be a big drop down. You just saw today some of the ISM numbers that came off from manufacturing projections. Those were super low. I think this sort of whiplash seesaw that we're going to see is doing no one any good. And there's going to be a lot of challenges. But that's sort of the clip I have for you right now.
So what I'm going to do now is I see the, let me see if they've started it. All right. So what I'm going to do now is just getting a confirmation. Listen, everyone, listen very carefully because this is going to be interesting. Let me just make sure we've never done it this way. So I want you all, while you're listening, just sign up to the newsletter up at the top. And then I'm just getting confirmation. Yep. So I'm going to pin something at the top. Fidjiro, are you with us, Fidjiro? He jumped
No.
off as well. Yeah, and I know why he's not there. So what we just did now is that the roundtable space just started. So I want you all, we're going to leave this open for a bit longer. Check the pinned tweet. I'm going to retweet it on my account and check it above. Anyone that's interested in crypto or anyone that's in the crypto space, I want you to check the pinned tweet above. I'm going to jump in there and continue the discussion, mainly focusing on crypto. If you're interested in crypto, want to learn more, want to understand if the bull market is back when everything was pumping, or whether we're just going to see potentially a what do you call it, a bull trap? I think that's what it's called. It means the market will drop again. Bit of an analysis there. What assets to look at? If you think crypto's dead, you're mistaken. So yeah, check it out. So we do this every week, this space, and we're going to be focusing on the Fed decision today and the moving my audience. All right, we're moving all there. I'm going to jump in there. So check the pin tweet above. It's retweeted on my account as well. Check it out. Jump in there. The space is going to end in a minute or two. So jump in there. I'm going to jump in as well. Retweeted on my account and pinned above. We're going to continue the discussion with a bigger focus on crypto. I think we did a great show today. It's the first time we covered the FOMC meeting live. We killed it, everyone. I really enjoyed it. We covered all the breaking news. We had the team in the background sharing updates live. I did a big thread with all the updates. We had incredible panelists. I want to give a shout out to Stock Talk and Ran, who did great spaces themselves as well as Unusual Whales. I think we're going to partner. Romy was messaging me. We might partner next time, do a big space together because these guys are beasts. But I really enjoyed it. Wahid, final thoughts as everyone jumps into the space that I retweeted and pinned above to continue the discussion there. Any final thoughts, Wahid, the fan favorite?
Hardly fan favorite. No. Thank you, everyone. Look, I think we keep holding these guys accountable. The one thing which I love about Twitter Spaces is that it's real citizenship journalism, completely decentralized and completely uncensored. And you know what? There's one establishment that gets very little scrutiny, and that's the Fed and other central banks. And then the journalists always give them layup questions. It's just you're not re-invited to the presser if you give any challenge. So to the extent that we keep pressing here, they'll be awesome. My challenge to you, Mario, is to try and get some Fed staffers to participate as well. Let's see if they dare. And yeah, that we can make this a killer show.
Imagine, Wahid, imagine we get Fed staffers in here. That would be epic. I don't think we'll be able to, but that would be insane.
Invite them. You should invite them because these guys have zero accountability. And let's just see. Let's just try.
Cool. Yeah, so that's, I'm just looking at the updates if there's anything else worth mentioning. We're going to be doing this again tomorrow. We do have the space on unrelated,